Let's now solve question number 1A from our model test paper 2 on advanced accounting. This question number 1A is on the topic of accounting standard 26, which deals with intangible assets. Why waste time? Let's start reading the question. K Limited launched a project for producing product X in October 2023. The company incurred 40 lakhs towards research and development. This R&D expenses is specifically discussed in Accounting Standard 26. Previously, there used to be a standard by name Accounting Standard 8, Research and Development. This standard got removed, and whatever that expenditure was there on research and development, its treatment was shifted from age 20, age 8 to age 26. Age 26 was revised to include this expenditure. Whenever you incur expenditure on research and development, accounting treatment is not same for both. We need to segregate how much is the expenditure incurred on research, how much is the expenditure incurred on development. On research, whatever expenditure is incurred to gain knowledge, it should be expensed by writing to P&L account. Expenditure incurred on development should be can be capitalized. Can be provided it fulfills six conditions, which is given under para 44 of accounting standard. So remember six conditions: technical feasibility, availability of resources, intention to complete, future economic benefit, and two more conditions are also there. You remember that? Yeah, see this? There should be technical feasibility of that particular project. There should be intention of ours to complete that project. We should have the ability to utilize that development or that research project say outcome, or we should be able to sell that, or we should be able to generate future economic benefit from this project. Ultimately, we should have adequate resources to complete this project, and there should be reliable measurement of the cost to be incurred to complete. Only when all the six checkpoints are ticked as per para 44 of AS 26, such development cost will be capitalized into an asset. Otherwise, further we discuss some more things. Whatever expenditure is incurred at research stage will be transferred to P&L. From development stage, it will be capitalized. We cannot take the old research expenditure to asset side now. We cannot be capitalizing it now. And what if you have no clue whether it is research or development? Then it is research only. If it is development, you will know that it is development. When it is gaining knowledge, you will not know. If you have already gained knowledge and you're developing the knowledge that you gain, you're using it, then you know that you are under the development phase. You understand this? This is part of our accounting standard 26. See, if unable to distinguish research and development expense, then it should be charged to P&L. You just have to write reference to it and then go ahead with the answer. They say due to prevailing market conditions, the management came to conclusion that product cannot be manufactured. Okay, so is it development or research? Research only. Further, it cannot be manufactured and sold in the market for next 10 years. Next 10 years, they will not be able to manufacture, they will not be able to sell. Not just now. Next 10 years, there is no future. There is no future economic benefit. So what should we do with that 40 lakhs expense? It should be expensed by debiting it to P&L. Do you agree? What are they trying to tell? We've done a similar question in the class. The management hence wants to defer the expenditure to write off over future years. The management, in our question, I think it told like the chief accountant wants to defer it over next 10 years. Is it right? It is incorrect. Can they defer? No. You can defer an expenditure to the further periods only when there is going to be future economic benefit. There is no future benefit. In fact, there is no present benefit also. Whatever expenditure is incurred, it should be transferred to P&L account once for all and then closed. You will start your answer by quoting reference of Accounting Standard 26. You will write expenditure incurred on research and development is regulated by Accounting Standard 26. Research expenditure should be expensed to P&L and development expenditure can be capitalized subject to fulfillment of six conditions given under para 44. Mention those six conditions. Done. Full stop. First paragraph done. Second paragraph will write, in the case of K Limited, such expenditure incurred of 40 lakhs on research and development has no future economic benefit because the product cannot be manufactured and product cannot be sold for the next 10 years. Second paragraph, matter of the case, or say, case information, whatever is available in the question, second paragraph. Third paragraph, conclusion. You will tell, based on the provisions of Accounting Standard 26 applicable on K Limited, such expenditure of 40 lakh should be returned to 300. That's our answer. I'll show you the answer. See, as per Accounting Standard 26, expense on development, expense on research, the treatment is different. Expense on research to be charged to P&L. Expense on development to be capitalized as intangible asset subject to fulfillment of conditions under para 44 of AS 26. Then, in the case of K Limited, research expense of rupees 40 lakhs has no future economic benefit, so it has to be charged to profit and loss account. Did everyone get this? Let's now solve question number 1B from our model test paper number 2. This question is on accounting standard 2 valuation of what's happening here. Wooden Plywood Limited has a normal wastage of 5%. Meaning, if you put 100 kgs of wood or 100 units of wood, the output will be 95. 5 units will be automatically damaged and it's normal. Normal is unavoidable no matter what you do. No matter how much increase the efficiency you do, how much training you give to the employees, whether you replace it by new machine or what, that wastage will be anyways there, it's unavoidable. And we've learned treatment of normal wastage in accounting standard. Whenever there is normal wastage, there is no journal entry. It will be deducted in the units column. The good units per unit cost will increase. 100 units cost is X. We deduct 5 units, which is normal wastage. 95 units cost will be same X. So X by 100 would have been the cost for the 100 units before normal wastage. Now, X by 95 is what we should do, because of which per unit cost of the good units will increase. So for normal loss, there is no journal entry, but per unit cost will increase of good units because of normal units. Further, the company used 16,000 empty metric tons, 16,000 metric tons of raw material, costing rupees 190 per metric ton. So beginning will be metric tons, rate per metric ton and value. 16,000, 190 and 16,000 into 190. Do 5% of 16,000. How much do we get? 800 units is expected to be lost. So if you expect 800 units to go as wastage from 16,000, you should get balance as how much? 15,000. They're telling at the end of the year, 950 metric tons was wastage in stock. Why wastage should have been 800 metric tons? It is 950. 950 metric tons is the total wastage. In that 800 is normal. 150 will be abnormal. I told you for normal there is no journal entry. For abnormal there is journal entry. For abnormal wastage, we write it in metric tons in units column. We also write the per unit value, whatever was there just before that, and write the amount in the value column also. So because there is value, we can pass journal entry. This will be reduced from the stock and written as expense in P&L. And because of this, there will be no increase in per unit rate. It will be same per unit rate. They're asking us, the accountant wants to know how this wastage is to be treated in the books. Maybe he also looks like wastage because he doesn't even know this. But good, when people don't know this, they come to you, take consulting, pay you fees. You also survive. Nation will also provide. Calculate the amount of abnormal loss. Explain the treatment of normal and abnormal. Shall we start? Fantastic. If you have any slight hiccups with regard to this, you can go back to revision video of accounting standard 2. We clearly discussed this. Normal loss, it reduces number of units, it increases per unit cost. There is no amount because there is no change here. Journal entry is not there. Because of abnormal loss, number of units will decrease and total value will also decrease of the entire inventory. And there is no change in per unit cost. There is accounting entry. Normal loss is adjusted only in units, increasing the cost of good units. There is no journal entry. Abnormal loss will not change per unit rate. It will remain the same, but value is assigned to it at the same per unit cost. There is an accounting entry transferring it to P&L. I hope everyone understood. Fantastic. If you want to recall what we did in the class we have taken the example of tomato. Transportation of tomato. Let's see this. Raw material. How many metric tons did we buy? 16,000 metric tons. Each metric ton at 190. If I multiply, I get 30 lakh 40,000 to be the value of. I will deduct normal wastage of 5%. How much is 5% of 16,800? Like I mentioned, I will not write anything in units or amount column because this is normal loss and there will be no journal entry associated to it. This will only increase the cost of good unit. So how will it increase? I'll show now. 16,000 units has been input into the system. 800 units is normal loss. So output will be 15,200 and 15,200 units cost will be same 30 lakh 40. If 30 lakh 40,000 is the cost of 15,200, how much is per metric ton cost? 30 lakh 40 by 15,200, which comes to 200. See, before this normal loss treatment, can I say per unit rate was 190? Now it has become 200. Hasn't it increased? That increased cost is because of normal loss. It is because of So that's what I was telling when I say per unit cost will increase. Let's go to the next aspect. See, there is abnormal loss, but in this question, they have not told how much is abnormal loss. They have told total loss is 950 units. In 950 units lost, I know 800 is normal. So out of 950, if 800 is normal, abnormal is 950 minus 800, 150. Do you agree? One for these 150, I will assign per unit rate of 200 very clearly. 150 into 200 will be very good. This 30,000 is abnormal loss. There is accounting entry for this. This amount has to be credited to inventory and debited to P&L. P&L account debit to inventory is the journal entry that you would pass, transferring this to your P&L. They have not asked. If you want, you can identify the rest of the inventory's value. 15,200 minus 150 is 15,050. At 200 rupees is 30 lakh 10,000. This, my friends, is the answer for question 1B in our model paper. Let's now solve question 1C from our model test paper number 2. This question is on accounting standard 13, accounting for investments. So what does the question say? On 15th of June 2024, Y Limited wants to reclassify its investments. See, for the purpose of accounting, we classify the investments into two categories. Number one, current investments. Number two, non-current investments. Based on the classification, we will do accounting for them. Now, when do we call an investment as current investment? As per accounting standard 13, an investment is considered to be current investment when point number one, readily realizable. Point number two, intended to be sold within 12 months or intended to be sold within a year. If it is readily realizable and intended to be held for less than a year, then it is current investment. What is non-current investment? Whatever is not current is non-current investments. Investment other than current investments is to be considered as non-current investments. And as per accounting standard 13, current investment should be valued at cost or fair market value, whichever is less. And non-current investment should be valued at cost. If there is decrease in the value below cost and such decrease is other than temporary in nature, that is permanent in nature, only then we need to provide for such a thing. Otherwise, it will be continued to be in cost. If the decrease is other than temporary, that is in permanent nature, then we will decrease it. So, initially you identified an item as current. Now, you are intending to hold it for more than 12. Can you change your opinion? Or you're like, no, available. Firstly, you told you, sir, now you have to sell. No, you can't enforce. No, they can change their idea of intending to hold it for less than a year to intend it to be held for more than a year. Then you are reclassifying it from current investment to non-current. From current, if it can go to non-current, it can come back from non-current to current also. You intended to hold an investment for 5 years. Later, you felt like, hey, go, yeah, 5 years is too much. I want to hold it for only 1 year now or less than a year. Can you reclassify it to current? Yeah, you can do. You understand what I'm trying to tell? When this reclassification happens, how to measure? Very simple. We've discussed this in accounting standard 13. When you reclassify an investment from current to non-current, it should be recorded at cost or fair market value, whichever is less on that reclassification. However, when you reclassify it from non-current to current, it has to be recorded at cost or carrying amount, whichever is less. Right, sure. This is part of our chart. If in case you have forgotten this, please do come back to this last two lines of our AQ's chart to revise this. See, when you are reclassifying it from current to non-current, intended to be held for less than 12 months to intended to be held for more than 12 months. It should be valued at cost or fair market value, whichever is less. Usually market value is fair market value. But if they give fair market value separately and market value separately, take fair market value. Understood? If nothing is mentioned, market value is considered to be fair value. Understood? If you're reclassifying long term to current investment, then original cost or carrying amount, whichever is less. Okay, in this case, what is the reclassification that's happening? A portion of long term investments purchased on 1st of March 2023 are to be reclassified as current. It is initially classified as long term. Now it is to be changed to current. Original cost is 14 and written down by 2 lakhs because the decline is other than temporary. So if you write down by 2 lakhs, what will 14 become? 12. The market value of this investments is 11. When it is becoming long term to current, you should record it at what value? What value? See, I've written the heading as per AS 13 investments, 2 lines. One, Long-term investments to be reclassified to short-term or to be recorded at cost or carrying amount, whichever is less. Long-term to short-term. Cost is told to be 14 lakhs and they've reclassified, sorry, they've reduced it by 2 lakhs because of other than temporary decrease or permanent decrease. Can I say that is 12? Fair value, we don't care. It should be recorded 14 or 12, whichever is less. Whichever is less is 12. Understood? That's the first point. 2 marks. And the second paragraph in our answer, in our question is a portion of current investments which was purchased on 15th of March 2024 for 7 lakhs. 7 lakh is cost. It is initially classified as current investments. This is to be reclassified as long-term investments. We are reclassifying it into what? Initially it was current. Now it is non-current. So when current to non-current, if it happens one last time, value is at cost or fair value, whichever is less, and then recorded. Understood? What is it told? As the company has the decided, the market value of investment is 6. Fair value is 8.5. Oh, what do we take? Yeah, whatever they tell is a fair value. Cost is 7 lakhs. Am I right? Carrying amount is don't know. Fair value is 8.5. Which one do we take? Yeah. Yeah. 7 lakhs. 7 lakhs. Which will record it? Everybody got it? Yes. This is the answer. I hope you've written. Let's now solve question number 2 from our model test paper 2. This question is on preparation of financial statements as per schedule 3. Let's begin. The balances appeared in the books of Oliva Company as on 31st of March. They've given trial balance. Don't break your head on this. Don't waste your time and energy reading this. Quickly come to the adjustments and spot the items in the trial balance which have adjustment, make a marking, and then start solving them from the beginning. First, do check whether they've asked you to do a draft only balance sheet or P&L and balance sheet or only P&L. Come to the end of the question. From the above balance of following information, prepare company's profit and loss statement as well as balance sheet as on that date. So let's make items which has adjustment to be marked first. Shall we do that? Inventory, they've given 25,800 and 60,000. This is as on 31st of March 24. This is closing inventory. Closing inventory will appear at 2 places in our financial statements. First place, it has to be reduced from opening inventory in statement of profit or loss under the heading changes in inventory. Second place, this will appear in our balance sheet as inventories. Understood? Asset side. Then outstanding expenses are there. Manufacturing expenses and wages. Because this amount is outstanding, this will be part of our expense as well as liability. The expense will be given in trial balance. To that expense, what is given in trial balance is what is paid. This is what is not paid. Both together will be our current year expense. So I need to make a marking next to manufacturing expenses and salaries and wages in my trial balance. Manufacturing expenses, it will be there on the debit. Do you find it somewhere here, here, here? Yeah, manufacturing expenses. 2,70,000 what is given here is paid. There is some element which is not paid. Both of them together will appear in my other expenses. So the extent it is outstanding, I'll read as other current liability, assuming it to be paid within next 12 months. Then salaries and wages. Salaries and wages, 40,200 is what is paid. But there is an element of salaries and wages which is not paid. Though it is not paid, it is still an expense. You get this? So to this 40,200, I will add that outstanding salaries and wages, what is there in the adjustments, and then write it not in other expenses, but in employee benefit expenses. And such an amount of outstanding expense, what is there in the adjustments, will also be written in balance sheet liability side under the heading other current liabilities. Did everyone get this? See, what's the next item with adjustment? First one over, second one over, third one. Interest accrued on securities. We have purchased securities. It will be there on the asset side somewhere here. Where do we have it? Investment. Is there any other item? Nothing, it's the same thing. That investment only. On that investment, we have earned securities interest 300. This is my income and asset. Why is it asset? Because it is not received. If it was received, it would have been part of cash, it would have been part of trial balance. Because it is not received, it's given separately. I will write this interest accrued on securities in my other income in statement of profit or loss. Also write it as other current asset in my balance sheet asset side. Got it? There is no item in trial balance to make a marking for. General charges prepaid is 2,490. So amount paid as general charges is given in trial balance. Do you find general charges here? How much is general charges? Here you go. This general charges of 16,500 is paid. Whatever is paid is not your expense. Out of the 16,500, 2,490 is for next year. Because 2490 is for next year, that is not my expense. Out of that expense in TB, minus 2490. Reduced amount will be written in other expenses. And this 2,490 should be written in other current assets. Sorry, loans and advances. It should be written in loans and advances. Don't write it in other current assets. Write it in loans and advances as our general charges repeat. We've written it specifically with an item as star in our notes. Yeah. Please do revise financial statements if you think you are missing these small cues. Next, provide depreciation on building, machinery, furniture, and motor vehicle. So here, building mele depreciation has to be provided. Then plant and machinery depreciation, furniture, motor vehicles. On all these items, I'll open one separate notes to accounts, that accounts called as property, plant, and equipment. There will write opening balance, depreciation, closing balance. Closing balance totals will go to my balance sheet asset side under the heading PPE tangible assets. The depreciation column total will go to my statement of profit or loss under the head depreciation and amortization expenses. Did everyone get it? What is the other item that we have? I think that's it. Lastly, we have provision for tax 40%. This will be computed in our statement of profit or loss. We'll read revenue from operation, other income, total income. I'll write all the expenses: consumption of raw material, purchase of stock in trade, changes in inventory, employee benefit expenses, depreciation, amortization expense, finance charges, other expenses, total expenses, income minus expense, net profit before tax. On that, I'll apply 40% as tax. After deducting that, whatever arrives is net profit after tax transferred to balance sheet. That will be that post-tax amount will be written in reserves and surplus. Whereas the tax amount, whatever I compute, 40% on our profit, will be written as short-term provision under current liabilities in liability side of balance sheet. This will be the last item. After I write this, I'll be able to find profit, after which I'll close my statement of profit or loss. Sorry, after which I'll close my reserves and surplus, then I'll close my balance sheet. Model test paper number 1 also has a similar question. Yeah, come on, let's start solving. I have told this in the past. Let me tell this to you all once again. When you're solving a question on financial statements in the examination, first paper, leave it for balance sheet. Don't write the format. Go to second paper, leave it for statement of profit or loss. Again, don't write the format. Or you can write P&L format. P&L format, almost every item will be there. Third paper will be balance sheet, liability side notes to account. Fourth paper will be balance sheet, asset side notes to account. Fifth paper, revenue from operations and other income, P&L income notes to accounts. Sixth paper will be expenses notes to accounts. If there is any extra note, write it in the seventh paper. Don't serially number the notes to accounts in the beginning. So leave first to 2 pages and then third page, fourth page, fifth page, sixth page, respective page, you write your notes to accounts. Total then. When you're posting it to balance sheet, then you write the serial numbers in the balance sheet and P&L and then name them. Then number them. It is okay if you write share capital notes to accounts, reserves and surplus notes to accounts, forgot to write long-term borrowing, good current liabilities. Then you write long-term borrowings notes to accounts. It's okay. But serial number will be 1 share capital, 2 reserves and surplus, 4 current liabilities, 3 long-term borrowings. Why? In the balance sheet, it's in the same order, no? After you post the total to balance sheet, number them in the balance sheet serially and then post it to notes to accounts. You understood what to do? You don't have to write the items in the balance sheet format if they don't have any value. And if item, for example, trade payables, in the trial balance, it's available as trade payables straight away. For example, here, you don't have to open notes to account. Straight away write trade payables in balance sheet. That would do. Understood? Or if there is only one item, next to that main item only, you can write subheading and then write it in the main format only. You will be still given full marks. Shall we begin? To begin with, we have inventory. This is opening inventory. Opening inventory of raw material. Oh, this is one more part that you should be careful. With regard to inventory, there are 3 variants. How many variants? 3 variants. Raw material, work in progress, finished goods. Let's start with finished goods. Where do we take finished goods? Finished goods, opening minus closing in changes in inventory. Closing finished goods in balance sheet. WIP? WIP also same story. Opening minus closing WIP in changes in inventory. Closing WIP in balance sheet assets in. With regard to raw material, don't take it in changes in inventory. Raw material will take opening plus purchase minus closing of raw material. Where? Consumption of raw material. And closing of raw material will be anyways written in balance sheet asset side. We have discussed this in detail when we did our topic of financial statements of companies. If you have any doubt, there is a quick revision video on YouTube. You can always go and then watch that part so that you clarify this. See, cost of material consumed is opening plus purchase minus closing of raw material. Purchase of stock and trade is of finished goods only. This will not come for a manufacturing entity. And changes in inventory, this is where we write WIP and finished goods opening minus closing. You got it? And in our regular class, we've done some cute AQs on this. You remember? Where are they? See, COGS computation, we did some cute AQs to get the good holding of the same. And also, we did some on changes in inventory. You remember that? Inventory classification, we did AQ number 30. If you are revising from the class notes, please go back to revise AQ number 13 and AQ number 14 to get complete holding of this. I've also given you a cute Nenapirli to recall the entire point on inventory. Got it? Let's get back here. So, raw material, where would I write? Opening raw material. Consumption of raw material. Opening plus purchase minus closing. 30,000. Right now, I know opening. Let's go to our answer. In our notes to accounts for consumption of material, I know consumption of raw material nalli opening raw material is 30,000. Understood? Then next item, finished goods. Finished goods opening will be used in changes in inventory. You should do opening minus closing or closing minus opening. Opening minus closing. Opening minus in changes in inventory, I'll write opening finished goods. How much? 46,500. This will wait here. Once I identify closing inventory, then I deduct it and post it over. Sir, I know it's there in adjustment. Don't jump. Always go in the order. Always go in the order. Then we have next purchases. Purchases 12 lakh 15. What did we purchase? Raw material. Sir, why don't we buy finished goods? See, when you have bought raw material, if you buy finished goods also, then why did you buy raw material? If you're selling shirts, you should buy cotton, make the shirt and then sell. If you buy shirts only, then why did you buy cotton? Maybe the purchase is of raw material, not of. So this 12 lakh 15 will go where? Consumption of raw material. Here opening raw material, I'll add purchase of raw material 12 lakh 15,000. Got it? Next, manufacturing expenses. Sir, manufacturing account. We are not doing sole proprietorship accounting. Whether it is manufacturing expenses or selling and distribution expenses, everything will go to other expenses only. You understood? Sir, but manufacturing expense is part of prime cost, selling and distribution overhead comes at the end. We are not doing costing. Remember, no? Paper number 1 is different from paper number 4. Nice. Manufacturing expenses 2 lakh 70. Why is it in yellow? There is an adjustment. There is some outstanding manufacturing expenses. So should I adjust it now? Now you will not do. You will write manufacturing expense in inner column, then paid. When you're writing next item to other expenses, you leave one line and then why? There is that adjustment that we should do for manufacturing expenses. What do we have after manufacturing expenses? Salaries and wages, 4,200. Don't write it in other expenses. This will go to employee benefit expenses. This also is in yellow, which means this also has an adjustment. Shall we write it in the inner column? Shall we? Oh my God. 40,200. Come to employee benefit expenses. I would write salaries and wages 40,200. Clear? What's after salaries and wages? We have general charges. General charges which would appear in other expenses 16,500. Again, that's also in yellow. For manufacturing wages, there is outstanding. For general charges, there is prepaid. But anyways, you don't have to remember that. I remember it, but you don't have to. When we read the adjustments, we will recall and then read. It is not a test of memory. It's only test of the process, accounting flow. What do we have after this 16,500 general charges? Interim dividend paid. Already paid. It's already paid. It's given as debit. So it's given in the debit items, no? So what does it mean? We would have to deduct it from our reserves and surplus. Am I right? Am I right? Yeah. When it is paid, it will reduce our profit. I don't know how much is my current year profit. I don't know how much is your previous year accumulated profit. I will write previous year accumulated profit. To this, I'll add profit after deducting tax. From that, I will deduct this interim dividend paid 27,000. I don't know those two. When I find it, I will write it. If in case this interim dividend was given on the credit side of the trial balance, it would have meant that dividend is declared but not yet paid. Then I would have written it in other current liabilities. You understood? Right now they've given this item as debit, which means what? It is already paid. It's already, they don't know what to deduct it from, so they've kept it. Debit is reduction in profit, no. So I'm reducing it by profit. So is it expense? A dividend is not expense. Dividend is appropriation of income, distribution of income, reduction in income post tax. Everybody got it? Don't write it in other expenses. Huh? Then building. Building is 1 lakh 1,000. Where do we write? PPE, tangible assets, PPE, tangible assets, PPE, building, opening WDV 1 lakh 1. There can be revaluation, there will be depreciation for sure. Yeah, after deducting, I'll find the closing WDV. Understood? So we're done with this. Should I go to next page and finish debit items and then come to credit items? Yeah, let's go in the debit side order now. Let's go to plant and machinery. Plant and machinery 70,400. Same, yeah. PPE. I'll write plant and machinery is opening WDV of 70,400. What's after plant and machinery? We have furniture to the extent of 10,200. I would write this also in plant and machinery PPE. Sorry, tangible assets PPE 10,200. Got it? Next, after that we have motor vehicles 40,800. That will also come here. Motor vehicle 40,800. Sir, vehicle ಬರ್ದಿರ motor ಬರೆಯೋಣ. Yeah, motor vehicle 40,800. Then stores and spare parts consumed. Stores and spare parts consumed will be written like inventory consumed. Cost of material consumed is there, no? There only will write it. You remember as per accounting standard 2, what to say, lubricants and then consumables, spare parts are not actually fulfilling inventory definition, but they will be considered like inventory. ಮರೆತು ಹೋಯಿತೆ ನನ್ನಯ ಹಾಜರಿ 5.1 accounting standard 2, we have clearly discussed this in the chart stating that certain items are considered as inventory. See here, material supplies, consumables and loose tools will be treated as inventory. They don't fulfill the definition of inventory as per para 3. It is not finished goods, it is not WIP, it is not raw material, but still treated like inventory because they don't have any other place to go. Inventory will tell it's okay. Come, I'll treat you along with my inventories. Adopted kid. So we write raw material, no consumption of raw material. There only we write this. They could have given opening spare parts, closing spare parts, purchase and everything. But good, they've given straight away how much is consumed. How much is consumed? 45. Please don't write it in other expenses. Yeah. Come to consumption of raw material. Here, I'll give little space. Why? What should I write after opening plus purchase? Closing. Jaga bitto. I will write here consumption of stores and space. How much? 45,000. Correct? Huh? Yes. Yeah. What's after that? Investment. Current investments 4,500. Non-current investments 7,500. Together 12,000. Shall I write them together under investments? No. Balance sheet we have a separate bifurcation. Current and non-current. Separate only. I don't think we need notes to accounts. Shall I straight away post it? Come to balance sheet. Straight away we'll write balance sheet, balance sheet, balance sheet. Non-current investments 7,500. Current investments 4,500. Did I write them? Any doubts so far? Perfect. What's next? Then we have trade receivables. Trade receivables, there is no adjustment, there is no provision, nothing. Balance sheet, asset side, current assets, trade receivables 238,500. Do you remember what adjustment can come for trade receivables? Yeah, we might mutual indebtedness is in amalgamation and consolidation. Here the adjustments will be outstanding for more than 6, less than 6, provision for bad debts, all of those adjustments. Anyways, we don't have them. 238,500. Done. Next, cash in bank. Cash in bank 2,71,100. There is no adjustments for payments or anything. I won't open notes to accounts. Balance sheet, asset side, current assets, cash and cash equivalent. 271,100. Kasu and Kas equivalent. Trial balance debit side done. Come to credit side of trial balance. Sales. Sales andre revenue from operations 17,10,000. If there is any sales return, I have to deduct from this, writing it in inner column by opening notes to accounts. By the way, there is no adjustment. If it was there, I would have marked it in the beginning. I read the rest of the question. 17,10,000 straight away P&L. Sir, notes to accounts ಬೇಡ ಬೇಕಾದ್ರೆ ಇಲ್ಲೇ ಸೇಲ್ಸ್ ಅಂತ ಒಂದು ಬರೆದ್ಬಿಡಿ ರೆವೆನ್ಯೂ ಫ್ರಮ್ ಆಪರೇಷನ್ಸ್ ಕೊಡ್ತೀವಿ rate 17,10,000. Sir, then that notes to accounts page may it will be empty. It's okay, draw one line like this. Only one line, huh? Don't draw one line like this, one line like this, and one more line like this. Make 2 mountains, sun, crows, river. Don't write, huh? Don't write. Then interest 3,900. This is income. Oh, there was that adjustment securities we did not know to add. So, anyways, don't worry. We'll open one other income notes documents and then write this in. Is that okay? Okay, friends. One other incomes notes to accounts. There I would write interest. How much is it there in the trial balance? 3,900 in our column. Later I'll add that accrued interest on securities and then post the total to outer column. If in case you forgot to open notes to accounts, no, later you realize, then it's okay. Yeah, there only next to other income, you write there only 3,900 plus that other amount and then write. It should be still okay. If you don't have space, if you don't have space, or if you write that notes to accounts at the end of the answer, last, after other expenses, still okay. It's absolutely fine. Then what do we have after that? P&L account 48,000. What is this? It is not current year profit. This is accumulated profit of previous year. Where would it go? In reserves and surplus, I would start with this balance only, 48,000. Then I would add current year profit after tax from statement of profit or loss. Then I would deduct that interim dividend paid. Balance would go to outer column, which will later go to balance sheet total. This will be the last item to be closed. Last item, everything will be closed. Once we write this, it's the last piece in the jigsaw puzzle. Got it? Next, share capital. How much? 3,15,000. They're having so many adjustments. They've not told anything. They've not even told how many shares are there or what is the nominal value per share. Authorized capital also we don't know. Then still you write authorized capital as the heading. Leave it blank and write paid up capital 3 lakh. ಅವ್ರಿಗೆ ಗೊತ್ತಾಗ್ಬೇಕು ನಿಮಗೆ ಗೊತ್ತು ಅಂತ. They should know that you know and you have not written because they have not given. Don't go ahead and then write one more thing, XXX number of shares of rupees XXX paid. Tell beta. Just write authorized capital, draw 2 lines and write paid up capital, write 3 lakh. Got it? Next, we have secured loans. Secured loans, short term 4,500, long term to 21,000. Together 2,500. We can't write them together in balance sheet. We have to write long term borrowings, short term borrowings separately. So we'll write them separate. Shall I? Straight away balance sheet only. Yeah. How much long term borrowings? I think we have opened one note for long term borrowings. No, long term borrowings we opened note. Debentures are there. Not there. Deposits are there. Okay. Long term loan, I opened one note 21,000. Short term, I'll write 4,500 as short term borrowings. Short term loan 4,500. If there was only one item, I could have written. I think there is one more. Deposits are also there, short term loan. So I opened more short term. Deposits, don't get confused as asset. There is short term loans and advances, long term loans and advances in the asset side of balance sheet format. That is loan given to somebody. Here, deposit is deposit received from somebody which is liability to you. So, how do we get to know? It's in the trial balance credit side. Credit side is liability. If it was given as debit balance, deposit, then it is P deposited money with someone, it would have become short term loans in advance, long term loans in advance. Because it's given on the credit side in trial balance, it is someone else has deposited money with us, towards it's a liability. Short term deposit amount will be written as short term borrowing, long term will be written as long term borrowing. Short term ಎಷ್ಟಾಯ್ತು 1,500, long term ಎಷ್ಟಾಯ್ತು 3,300. Got it? Say something. What's after that? Trade payables 3,27,000. Trade payables, there is no adjustment. I'll write straight here. In balance sheet, liability side, trade payable 3,27,000 straight without any notes. Understood? Then anything else? Entire trial balance is over. One adjustment at a time. 6th adjustment. Shall we begin? First one, inventory. Raw material 2,500. Where will this go? Changes in inventory? No. Consumption of raw material and balance sheet asset side inventory. Balance sheet asset side inventory will write later. All the three will write together. But right now I'll write in consumption of raw material. Consumption of raw material, notes to accounts for P&L, expenses side. There are three things. One, opening plus purchase minus closing. Opening written already. Am I right? Purchase also written already. Last day I'll write closing. How much? 25,800 from here. We'll find the closing balance. It will be how much? 12,19,200. Shall I write 25,800 or should I wait for finished goods also? Let me write here. Inventory, balance sheet, asset side. How much is raw material inventory? 25,800. Understood? Then finished goods closing inventory is 60. Where would this come? Two places. Number one, changes in inventory, opening minus closing. Number two, inventory is balance sheet asset side closing. 60,000. Inventory, I'll write first. Finished goods 60, making it 85,800. I need not write the total. I can wait for WIP, but I know there is no WIP, so I've written. But you wait, okay? Or should I also not write? Then come to changes in inventory, which is right below consumption of raw material. Opening minus closing. 46,500 minus 60. It will be minus 13,500. If in case we have WIP opening and closing, that would also be written here only, opening minus closing. But we don't have any WIP information. Do we have any? So ನಮ್ದು ಹೇಗೆ ಅಂದ್ರೆ WIP ಇಲ್ವೇ ಇಲ್ಲ. Either raw material or finished goods. ಕೆಲಸ ಮುಗಿಯೋವರೆಗೂ ಮಲಗೋದಿಲ್ಲ. ಸೂಪರ್ ಅಲ್ಲ? Nice entity. Outstanding expenses. Manufacturing expenses 67,500. It is expense, but it's not paid. So it is expense and liability. Manufacturing expense 67,500. I'll write in other expenses. See, 2,70,000 is waiting. I'll add outstanding 67,500 to make it 3,37,500. And because this 67,500 is not yet paid, it will become liability. Where? Other current liability. Other current liability. I'll write outstanding manufacturing expenses 67,500. Understood? Next, what do we have? Salaries and wages of 4,500. This will be added in employee benefit expenses. We have opened one note for employee benefit expenses. Salaries and wages 4,200 paid. Add outstanding amount, which is 4,500, making it 45,000, 44,700. Then this 4,500 should have been paid. Because it is not paid, it will become liability, and its liability is written in other current liability. I'll write here below outstanding manufacturing expenses, outstanding salaries and wages 4,000. Understood? What do we have after this? Then interest accrued on securities 300. This is interest earned but not received. Interest earned but not received. So it will be other income. Interest is already there. We'll add. And this will be written as other current asset. It's not received, no? If it was received, my cash and cash equivalent would have increased. Because it's not received, it is other current asset. Shall I? 300. Come to other income. Other income interest is waiting in inner column. Interest is telling, baba, ನಿನಗೋಸ್ಕರನೇ ಯಾವಾಗಿಂದ ಕಾಯ್ತಾ ಇದ್ದೀನಿ. 300 add ಮಾಡಿದ್ರೆ 4,200. Where else do we write this 300? Other current asset. Interest accrued on securities 300. Okay. What's after interest? General charges prepaid 2,490. What do you mean by prepaid? We already paid, but we have not taken the benefit. When will we take benefit? Next year. We told itkondige amele benefit togolti. Amele will take service. General charges paid. So what is appearing in trial balance is expense paid, but expense paid is not expense incurred. In other expenses, we would have written general charges. From that, I will deduct 2,490. Come here. I will deduct 2,490 because it is next year's expense. Then expense will become 14,010. Because this is next year's expense, it will go to next year P&L. ರಾತ್ರಿ ಎಲ್ಲಿ ಮಲ್ಕೊಡುತ್ತೆ? ಅದರ್ ಕರೆಂಟ್ ಅಸೆಟ್. ಯು ಅಂಡರ್ಸ್ಟುಡ್? ತುಂಬಾ ಲೇಟ್ ಆಯ್ತು, ಬರೋ ವರ್ಷಕ್ಕೆ ಬೇರೆ ಹೋಗ್ಬೇಕು ನೀವು. ರಾತ್ರಿ ಇಲ್ಲೇ ಮಲ್ಕೊಂಡು ಬೆಳಿಗ್ಗೆ ಎದ್ದು ಎಲ್ಲಿ? ಅದರ್ ಕರೆಂಟ್ ಅಸೆಟ್ ಅಲ್ಲಿ. ವಾಟ್ ಡು ವಿ ರೈಟ್ ಇಟ್ ಆಸ್? Short term. Short term loans and advances. Shall I write balance sheet only straight? Short term loans and advances, prepaid general charges 2,490. It's an advance paid for next year. You get it? Yeah, non-schedule 3 balance sheet, we'll write it in other current assets. Sorry, current assets, so forgot. It's actually a current asset. I am right. But current asset is residuary heading. Specific heading is prepaid general charges is written as short-term loans and advances. If you want, you can open notes to accounts for the same. Then depreciation. Building 2%, machinery 10%, furniture 10, motor vehicle 20. Shall we provide? Building 2%. Come to notes to accounts on PPE. Building 1,01,000, no revaluation. 2% depreciation will be how much? 2,020. Am I right? Then closing will be 1,01,000 minus 2,020. 98,990. Plant and machinery 10%. 10% of 70,400 is 7,040. If you deduct it, you will get 63,360. Then on machinery 10, furniture 10, 1,020. If you deduct, you will get 9,800. And on motor vehicle, you need to provide 20%. 20% of 40,800. 8,160. 4,800 minus 8,160. This total of current year depreciation, whatever is there, 18,240, will go to depreciation and amortization expenses. Total of WDVs, 2,04,160, will go to PPE, tangible assets, asset side of balance sheet. We'll post them later. We'll finish all other adjustments. Everything done. Provision for tax, 40%. This has to be written in our P&L. Statement of profit or loss, we'll find income, expenses, profit before tax, tax at 40%. And this 40% amount, whatever I compute here, should be written in balance sheet, liability side as short-term provisions, provision for. We'll write this later. Right now, I don't know. I can apply 40% on net profit. Only if I know net profit. To find net profit, I should know total income, which I don't know. I should know total expense, which I don't know. I have information. I just have to total them and then transfer. Shall I do it? That's it. Entire question is over. Now we don't need question paper. Now look at the notes to accounts one after the other. Share capital 3,50,000. Shall I post this to balance sheet? Yes, sir. Balance sheet, liability side, shareholders fund, share capital 3,50,000. Note number 1. Reserves and surplus is there. Note number 2, but I won't be able to complete. Why? I know opening P&L. I know dividend. I don't know current year. This I'll get to know after tax. I'll wait. This will be the last notes to be closed. Long-term borrowings 24,300. This will go to my balance sheet. Long-term borrowings. Note number 3, 24,300. Then current liabilities. Short-term borrowings is there? Yes. Note number 4. Shall we see what's there? How much is short-term borrowings? 6,000. Shall I post other current liability also simultaneously? 72,000. So 6,000 and 72,000. Short-term borrowings 6,000 and trade payables already written. Other current liabilities 72,000. Any doubts? No. Provision for tax is to be found later. So right now, I don't know. Come to asset side. PPE nalli, I should write tangible assets total. Note number 6. Do we have this data ready? Yeah. Which one? Current year depreciation total or closing WD? How much? 2,04,160. Come to balance sheet, asset side, PPE, tangible assets, 2,04,160. So these are the items without notes to accounts, already posted. Inventory will be our note number 7. Chala, for a reason. Shall we write note number 7 inventories? Come to note number 7. 60,000 plus 2,500, 85,800. 85,800, 85,800, note number 7, inventory. Everything else in the balance sheet is done. Sir, shall I take total? No. You don't have one item on the liability side. Sir, I'll find it as balancing figure. I've told you several times. Balance sheet as balancing figure. Oh, one more item is there. Other current assets. Shall we write? How much is other current asset? 300. 300. 100 is received already. Only 300 is accrued interest. Then come to P&L. Revenue from operation we know. Other income. We have that interest accrued as well as current year interest together. How much? 4,200. Shall I post 4,200? Other income 4,200. So total income is 17,14,200. Can be found. Cost of material consumed, we've done one note. Opening plus purchase minus closing, consumption of that space and everything. Note number 10. How much is it? 12,19,200 plus 45. 12,64,200. Post it to statement of profit or loss. 12,64,200. Understood? Then purchase of stock in trade. This is not there. We have not purchased any finished goods. Why? It's a manufacturing entity. What we purchased is raw material. If you purchase raw material, it should be considered in cost of material consumed. If in case you write purchase of raw material as item here, no. First purchase of stock in trade should have not written. You written 1 mark cut there. And your cost of material consumed is become wrong. Why there you have not considered? Alone mark cut. So 2 marks the mark. Though you spent enough time and then written everything just because you forgot some basic, simple things. To ensure that you don't miss out on the small details, repetitive revision is very important. Open the chart book, all the star items, read them. All the items given in Ninapirali, read them. Revise it regularly so that you don't miss out on the small points. What do we have next? Changes in inventory. Opening minus closing. We've done for finished goods. WIP, so anyways, it's not there. How much changes in inventory? Minus 13.5. Sir, minus Write it like that only. Minus 13,500, you write minus 13,500. This changes in inventory is one item in P&L which can be negative, which can be then employee benefit expense. We have salary and wages paid plus outstanding. Note number 12. How much? 44,700. Shall I write other expenses also together? 337,500 plus 14,010. Can I say 351,510? 351,510 will go to other expenses. 44,700 will go to employee benefit expenses. I'll write them together to statement of profit or loss. 44,700 and other expenses 351,510. There is no finance cost. Interest cost is not there. But depreciation and amortization expense is there. Where is it there? It's there in PPE notes to accounts only. So same PPE is note number 6 only will be written here. Go to note number 6. See current year depreciation total is available, which is 18,200 and I'll write 18,240 here. Everything is written. Total income is also available. Total expenses 1264,200 minus 13,500 plus 44,700 plus 18,240 plus 351,510. 16 lakh 65,150. This is total expenses. Deduct this from total revenue of 17 lakh 14,200. 49,050 is profit before tax. Now we would have to charge tax, create provision for tax at 40%. How much is 40% of 49,050? Don't go to profit after the tax amount. Okay, first 19,620 is an expense. It is reduced from profit. Did you pay? If you pay, we have to deduct from cash and cash equivalent. It is not yet paid. So this 19,620 has to be written in a minus. Very good. Short term provision. Shall I write? 19,620. See, from then we are waiting to write this. We had written heading also. Am I right? Last thing. How much is the profit for the year? 29,430. This will go to reserves and surplus. We had written opening. We were waiting to rate current year profit. Right? 29,430. Add 48 plus 29,430 minus 27,000 interim dividend paid. This is interim dividend paid. Interim dividend paid from the profit. So profit has reduced. How much is the reserves? 5430. Last item to be posted to balance sheet liability side. Note number 2, 50,430. Now take the total on the liability side of balance sheet. What do we get? 8,14,350. Same to same total as we found on the asset side of balance sheet. Check it out. Do we get 8,14,350? Do we get 8,14,350? Yes, we get 8,14,350. And that, my friends, is how the balance sheet tallies in question number 2. Let's now solve question number 3A from our model test paper number 2. This question is on accounting standard 29, provisions, contingent liabilities and contingent assets. Let's read the question. XYZ Limited has not made provision. They have not made provision for warranty in respect of certain goods. So we have a similar question on warranty, not exactly same. That was computation based. In our May 2025 examination, if you have not done any questions based on numbers of AS29, please revise May 25 examination warranty based computation question. Anyways, this is a theoretical question. Let's continue reading. You have not done provision on warranty. Firstly, what do you mean by warranty? You sold goods in this year and you told them warranty 1 year or warranty 2 years. Means what? After you sell the product, if the customer finds any discrepancy in the product's performance, they can bring the product back to you. You will not replace it with a new product. That is guarantee. Warranty means you will repair it. And when you repair, you would incur some labor cost, sometimes some material cost also. You would not charge the customer for such repair. That's what we mean when we say warranty. You would incur labor expense, you would incur material expense in repairing the product already sold, and you will not charge the customer. I've sold the goods this year. Customer will come back to me next year. Next year I incur expense, but I cannot charge. So I know, no, I can expect that expense. I have to create provision for the same. What do you mean by provision? Provision is a present obligation. Sir, how can warranty be present obligation? Today, when I sold only, I signed no warranty card, put to seal, signature, date, saying that if there is any problem, come back to me. I will repair. I have created an obligation on me in the present by signing that warranty card. And why did this present obligation arise? Because of a past event. What did I do in the past? Sold the goods. And this will result in outflow of resources. What resources? Labor expenditure, material expenditure. So this, my friends, is a provision. But provision is not actual liability. It is an expected liability. So contingent liability will become provision if it fulfills two conditions. Number one, probable outflow. Number one, probable outflow. You expect to incur expenditure. Number two, reliable estimate. For a liability, there will be actual amount because you know how much is the money obligated to be paid. In provision, you don't know how many times the customer will come. You don't know how much will the repair expenditure be. So you need to have a reliable estimate. Past data, present situation analysis, everything together, reliable estimate will be made. When probable outflow and reliable estimate is made, then the contingent liability will become provision. This warranty is no longer a contingent liability. It is a provision. You have to create provision. Do you agree with me? That is the provision as per accounting standard 29. Let's see further. What are they told? Due to the fact that they have not created provision. No, why is it that they did not create? They're giving reason. Due to the fact that company can claim warranty cost from original supplier. Okay, so we are trader. We're buying the product from somebody, selling it to customer. If the customer has a problem with the product, he will come to us. We will do service. But the money that I'm incurring for labor and then repair cost, I will not collect it from my customer, but it will be reimbursed by my supplier. The one who supplied the product to me originally, he has given default product. So whatever warranty service I give, it will be reimbursed from my supplier. They're telling because expenditure incurred for warranty service will be reimbursed by my supplier. I will not create provision. You cannot direct your customer to go to your original supplier. No, you have to give service and you have to recover from your original supplier. You got it? So you cannot say, I don't have liability towards my customer and I will not even record asset from my original supplier. You can't tell that. You need to record a liability and asset. Yeah, there'll be offset. There'll be net off. You incurred 100 rupees for warranty, you will recover 100 rupees from original supplier. But you need to record both. You need to record liability is for the service that you should give to your customer, which will be provision in your balance sheet, and the recovery that you should do from your original supplier, reimbursement, will be recorded only if there is virtual certainty. Only if there is no virtual certainty, it will become contingent asset. Contingent asset, leave recording in balance sheet. It should be not disclosed also. Will you disclose contingent assets? It is not recorded in balance sheet asset side. You won't even write it in notes to accounts as disclosure. If there is virtually certain that you will recover that money from your original supplier, then you can write it as an asset in balance sheet. When you have incurred, documentation is right, you have sent it, and there is 100% guarantee that they will give, then you can record it as asset. What is XYZ done here? They told, I have incurred service, I will receive it from my original supplier, so I will not create provision. I will not create. Are they right in this? No. Hence, the accountant of the company says that company is not having any liabilities. They're saying they don't have liability. It's not that they don't have, they have a liability and equivalent asset. They have a liability and equivalent. So you need to use these words. Liability has to be created by way of provision because there is probable outflow, reliable estimate. Liability, provision, reliable estimate, probable outflow. Four words. First part. Second part. Warranty is an asset recorded based on virtual certainty. If you use these keywords, rest of the answer, whatever you write, you will get full marks. Then they've told you are required for warranties for a particular date as of the amount gets reimbursed. Same story. You are required to comment. First paragraph, you write as per accounting standard 29, provisions, contingent liabilities, and assets. Provision has to be created for present obligation arising because of a past event whenever it fulfills the conditions of probable outflow and reliable estimate. We've revised this definition so many times. We have the same definition in our chart also. Do you agree? If not, please do revise accounting standard 29. See, present obligation as a result of past event with probable outflow and reliable. Got it? Then contingent asset should not be disclosed anywhere. Should we disclose it anywhere? No. Whereas if it is the If there is virtual certainty, it will be recorded as asset. Meaning, if you know that it will become an asset, then you should record. Then provision for warranty repairs has to be created as obligation arises and fulfilling conditions of probable reliable estimate. Further, reimbursement availability cannot neutralize creation of provision. You cannot say, I'll get it reimbursed, so I'll not create provision. ಇದು ಇದೆ, ಅದು ಅದೇ. ಇದು ಮಾಡಬೇಕು, ಅದು ಮಾಡಬೇಕು. ಇದು ಪಣ್ಣನು, ಅದು ಪಣ್ಣು. ಇದು ವಿಡಮಾಟೆ, ಅದು ವಿಡಬಿಡು. I don't know if it is correct. Okay, fine. Thank you. Reimbursement to be recorded as contingent asset based on virtual certainty. This, my friends, is the answer for question 3B from our model paper number 2. Got it?
Let's now solve question number 3B from model paper 2. This question is on the topic of internal reconstruction, a 14 marker. Have a look. What does the question want us to do? The balance sheet of Radhika Limited as on 31st of March 2024 is as follows. Come to the end. They have given balance sheet with notes to accounts. They have requested you to prepare the balance sheet of the company after the completion of the scheme. A 10 marker, not a 14 marker. So marks are allocated only for balance sheet. But in order to do balance sheet, we need to know the revised figures. In order to know the revised figures, we need to do that up and down. It's always nicer to do it with journal entry. It's easy taking plus minus in journal entry and then doing it. So do journal entries as working note. You don't have to write it detailedly. You don't have to write the full account name. You don't have to write narration. You can write it for your understanding only. Journal entry quickly. Debit this R account debit instead of writing reconstruction account. And credit equity share capital ESC, PSC like that. Shall we begin? First adjustment. Equity shares to be reduced to rupees 20 each. Right now, equity share is rupees 100 each. Shall I reduce it to 20? Reduction is 80. So 9 lakh divided by 100 is 9,000 shares. Each share is reduced by 80 rupees. I will debit equity share capital account. 9,000 shares into 80, 7 lakh 20,000 will be reduction. I am assuming the reduction is only in the paid up value and not in the nominal value. If you would have assumed it is reduction in the nominal value, you would have debited equity share capital 9 lakh to reconstruction 7 lakh 20 to equity share capital 1 lakh 80. Is that wrong? Not wrong. Your balance sheet will still tally. That's an alternative assumption. That's okay. Balance sheet will still tally at the same amount. That's not wrong. But this is the right thing. What's after this? Then let's go to the next adjustment. Next adjustment. Preference shareholders would give up 30% of their capital in exchange for allotment of 11% debentures to them. How much are we supposed to pay to our preference shareholders? 4 lakh 80. I will debit preference share capital account by 4 lakh 80. Credit preference share holder by 4 lakh 80. Don't directly adjust. First transfer from capital to holder, then holder to capital reduction, holder to debentures. We were supposed to pay these preference holders 4 lakh 80. They waived off 30%. So 30% of it I'll transfer to reconstruction or capital reduction account. Balance 70% is settled by issue of 11% debentures. 11% debentures will be 4 lakh 18 to 70% or 4 lakh 80 minus 1 lakh 44, which comes to 3 lakh 36. This would appear in the balance sheet. But balance sheet later. First finish off all the entries. Then the third adjustment. What is the third adjustment? Of the preference share dividends. Once again, is the arrears of dividend in the balance sheet liability side? No, no. It's a liability outside the balance sheet. So, if in case you write off this arrears of preference dividend, there would be no journal entry. If you write off, there is no journal entry. If in case you settle it, entry will be capital reduction account debit or reconstruction account debit to whatever you give, cash, share, debentures or whatever you give. What are we doing? Which are in arrears for 4 years. Oh, how much is arrears? 4 years is arrears. How much are we paying? 3/4 is waived off. Basically, out of 4 years, 3 years worth of arrears of preference dividend is waived off. How much is paid? 1 year. 1 year is paid at rupees 20 each by equity shares of rupees 20 each. Okay. Tell me how much is the money that I'm supposed to pay them as arrears of preference dividend of the balance sheet liability? 6% of 4 lakh 80. 20, 28,800. This is settled by issue of equity shares of rupees 20. Can I say we should issue 1440 shares? I would write here 2 equity share capital 28,800. The arrears of preference dividend is settled by issue of equity shares of rupees 20 each. 4 years dividend is arrears, 3 years dividend is waived off, 1 year dividend is settled. 3 years waive off, there is no entry. 1 year that you paid, there is entry. I hope you all understood this third one. Let's go to what's next. Fourth one. Interest payable on debentures is to be paid in cash. Okay. How much is interest payable? Interest payable 27,000. If you pay it by cash, interest account debit to bank account and cash account 27,000. You want me to write cash? Okay. Cash. Everywhere we wrote cash, no? Everywhere we've written cash, we'll write cash. Interest payable account debit to cash 27,000. Then come to the next adjustment. Goodwill is to be written off. Goodwill is an asset. When you write off, you should credit. Inventory to be written off. Inventory also will be credited. Amount of 68,500 provision for bad debts. That's a liability to be created. Credit. Can I combine 567 into one entry? Internal reconstruction account or reconstruction account or capital reduction account, whatever it is, debit to goodwill, to inventory, to PBT. Sir, why not eighth one? That is freehold property revalue. I think it's revalued upward. Yeah, from 5 lakh 10, you are revaluing it upward to 6 lakh 49. That will write separate entry. Shall I write 5671 entry? Reconstruction account debit to goodwill, to inventory, to provision for bad debts. How much should we write off goodwill? Check the balance sheet. Goodwill is 1 lakh 56. We will write off 1 lakh 56. I will create 1 lakh 56. Inventory. 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 How much is inventory? 5 lakh 10. It is written down to what value? Written down by 65. Okay, credit 65. Provision for bad debts is to be created at 68. That also is created. Take the total 156 plus 65 plus 68,500. 2,18,500 is debited to reconstruction or capital reduction account. Now we will do upward revaluation of freehold property. Freehold property is revalued at 6 lakh 49. What is the freehold property value here? 5 lakh 10. 5 lakh 10 to 6 lakh 49 is 90 plus 49. 1 lakh 39,000. Debit freehold property by 1 lakh 39. Credit reconstruction or revaluation account by 1 lakh 39. We revaluing the freehold property upwards. I hope you understood. What's after that? Ninth one. Investments are sold for rupees 1 lakh 20. What is the value of investment here? 66. It is sold for what value? 1 lakh 40. Debit bank account by 1 lakh 40. Credit investment account by 66. Difference will be credited to reconstruction. Profit on sale of investments is credited to reconstruction. Any profit or any loss, any expense or any income in the process of reconstruction is to be transferred to reconstruction or capital reduction account. How much? 140 minus 66, 74,000. I hope you understood. What do we have after this? Directors to accept settlement of their settlement means full loan will be closed. How? 90% thereof by allotment of equity shares. For 90% value will give equity shares. Credit equity share capital at rupees 20 each. As to 5% in cash, 5% will pay cash, 5% waived off. How much is directors loan? Directors loan 1 lakh 20. Loan will decrease, debit directors loan by 1 lakh 20. Credit equity share capital 1 lakh 20,000 into 90%, 1 lakh 8,000. Credit cash by 1 lakh 20,000 into 5%, and credit reconstruction or capital reduction 1 lakh 20 into 5%, which is 6,000. 1 lakh 20,000 is the loan. 90%, which is 1 lakh 8,000, is settled by issue of equity shares. 6,000 we gave cash and 6,000 is waived off by transfer to reconstruction account. Done. Loan is closed. Loan will not appear in balance sheet anymore. 11th one. There are capital commitments of rupees 2 lakh 50. These contracts are to be cancelled by payment of 5%. If we have continued the business without reconstruction, we have fulfilled this contract. Because we are cancelling the contract, we will not be able to fulfill this contractual requirement. To 2 lakh 50 into 5%, to 12,000, we will pay this expense. I told you any expense, income, profit, loss to be transferred to capital reduction. I'll write reconstruction account debit to cash account. We will pay 2 lakh 50 into 5%, 12,500, 12,500. Everybody got this? Fantastic. What's after this? Ignore taxation and cost of scheme. We will always ignore the same. Eliminate debit balance in P&L. Okay. To the extent available, we will eliminate. Okay. Capital reduction, if it is insufficient, we cannot eliminate. How much is debit balance in P&L? P&L, 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 P&L. 6 lakh 42. Keep that in mind. Let's take how much is available in reconstruction. Shall we check how much is available in reconstruction? Everyone with the calculator ready. Only once. You should not tap it 3 times. AC button. 7 lakh 20. You take as minus 7 lakh 20. First entry. Then minus 1 lakh 44. Then plus 28 800. Then plus 2 lakh 89 500. Then minus 1 lakh 39. Minus 74,000. Minus 6,000 plus 12,500. What do we have left? 7 lakh 52,000. How much is there in P&L to be written off? 6 lakh 42. Is it sufficient? Yeah. We have excess. Sir, excess will be used to write off goodwill. Goodwill already written off. Any balance will be transferred to capital reserve. How much? 1 lakh 10,000. We need to take the old balance sheet plus the items in this balance sheet. Sorry, items in this journal entry to arrive at the new balance sheet. I took 10 minutes. I took 10 minutes to write the entries in detail. If you write it half-heartedly without narration, you can take 7-8 minutes at max. In a minute, you can pass 2 entries very comfortably. Can I now do balance sheet? Balance sheet is simple. Old balance sheet, what is given in the question, plus the journal entries what you passed will be new balance sheet. You will not go wrong if you do like this. 100% your balance sheet will tally. Why? The balance sheet given in the question is tallying, and the journal entries you always need double entry. Am I right? Focus. The first item. Note number 1. 13 lakh 80. See the share capital. 9,000 equity shares or rupees 100 each. 9 lakh. Take 9 lakh in your calculator. 9 lakh in your calculator. Did you take 9 lakh? Come to the entries from the beginning. Equity share capital. Debit. So minus 7 lakh 20 money. Did you do minus 7 lakh 20? Anywhere else equity illy. Plus 28 800. Then equity. Plus 1 lakh 8,000. How much do we get? 3 lakh divided by 20. 15,840 equity shares of rupees 100 is 20 paid up. You could have assumed it to be 20 is 20 paid up also. Some shares are issued to loan directors. Some shares are issued to arrears of preference dividend. Both of them together is issued for non-cash consideration. How many shares did we give against loan? 1 lakh 8. Take 1 lakh 8 in the calculator and also take 28 800 in the calculator. 1 lakh 8 plus 28 800. 1 lakh 36 800 divided by 20. 6,840. 6,840 shares are issued for non-cash consideration. Some part of it towards arrears of preference dividend to preference shareholders. Some part of it to debtors against the balance loan. Understood? Mandatory disclosure. You don't do this, don't expect marks. Then preference share capital next in the balance sheets notes to accounts. 4 lakh 80 in the calculator, everyone. Did you take 4 lakh 80 in the calculator? Come on, journal entries. You have 4 lakh 80, 4 lakh 80 here. Daman, gone. Wait. 4 lakh 80 Daman. Gone, no? Here preference shareholder credit, preference shareholder debit. That's also gone. Nowhere else you have preference share capital. Anywhere? So only equity share capital is there. Come to next. Reserves and surplus. 6 lakh 42,000 was there. 6 lakh 42,000 was, we've written off here. 6 lakh 42,000 is now gone. It's not there. In the balance sheet, we will not show P&L account debit balance. Next, long-term borrowings, 4 lakh 50. This is 6% debentures. Remember, 6% debentures is 4 lakh 50. You issued debentures here, but that's different. Don't add them. Write them separately. Shall I write them separately? In my notes to accounts, I'll open one notes to accounts for long-term borrowing. I would write 6% debentures, 4 lakh 50 separately. 11% debentures, 3 lakh 36,000 separately. Together it is 7 lakh 86. We'll post it to balance sheet later. I hope everybody got this. What is after this? 6% debentures. Next I have with me loan to directors, 1 lakh 20. Was there, now not there anymore. 1 lakh 20 I have debited. I'll show you. I'll show you. See, 1 lakh 20. With the then interest payable 27. We paid that interest. Somewhere I've debited. Gone. Done. So basically, in the balance sheet, on the liability side, 13 lakh 80 done, 6 lakh 42 done, 4 lakh 50 done, 3 lakh 60 trade payable, bank overdraft 2 lakh 34 we have not touched. Shall I rate them as it is in the balance sheet? I am not touching bank overdraft. I am rating all the transactions through cash. I'll rate it as it is. They have given in the balance sheet. I am rating it in the balance sheet. I am not changing their figures. How much is that trade payables? 3 lakh 60. How much is that bank overdraft that they've given? 2 lakh 34. I'm rating it as it is. They've given. There is other current liability. That is that interest we paid. Loan to directors and interest. Fourth one. Loan to directors and interest. You paid it. That is settled. Liability side done. Can I take you to asset side? Come to the asset side. Property, plant and equipment. 5 lakh 70,000. Did we touch? Yes, yes, yes. Sorry, sorry, sorry. Freehold property, we've changed the value. Okay, sorry, sorry. Freehold property 5 lakh 10. Take 5 lakh 10 in the calculator. Add 1 lakh 39. How much will it become? The other asset plant we did not touch. Plant we did not change anything. No. As it is 60. Together 7 lakh. I hope this is not fast. Then plant 60 done. Goodwill 1 lakh 56 was there. We've written off here. Where? Here. 1,56,000 is gone. So it will not appear in the balance sheet. Patents 45. This will come. Intangible asset. Shall I write directly in the balance sheet? My notes to accounts. Intangible asset, how much? 45,000. If you want, I'll write the word here. Patents 45,000. Then what is the next item after patents in the balance sheet? Non-current investments 66,000. We sold this investment. 66 here, 66 I'll show you credit. We sold. Where did we sell? Here. Investments are sold. Gone. Then we have 5 lakh 10 inventory. We revalue it. Take 5 lakh 10 in the calculator. Here is our revaluation. 678 here. We wrote off 65,000. Deduct 65. 4 lakh. You want me to write in notes to accounts or directly balance sheet? 5 lakh 10 minus 65. 4 lakh 45. Correct. What's after this? Trade receivables 5 lakh. Take trade receivables 5 lakh in the calculator. Do we have it anywhere here? Sorry, I'm going to say in the journal entry. Yes, PDD. How much PDD. 5678. 68,500 will show the deduction. We'll open one notes to accounts. I would write trade receivables at 5 lakh. Deduct provision for bad debt 68,500. Show 4 lakh 31,500 the closing balance. Is it okay? Then cash and cash equivalent 82 on. There's a lot of things that's going to happen here. Take 82,000 in the calculator. Did you take 82,000? Nothing here, nothing here, nothing here, nothing here. Here, paid, so minus 27. Interest paid, so minus 27. Then this also will change into cash. Add 1 lakh 40. Did you add 1 lakh 40? Then deduct 6,000, loan repaid. Deduct 12,500, reconstruction expense paid. How much do we get? 76 500. 1 lakh 76 500. Directly I've written. If you want, you can open one notes to account, write all the plus items, minus items separate. If in case you don't do journal and you directly do balance sheet, you need to do working note for cash. Instead, journal is easy. If you do working note, all the cash transactions should identify at once, which is difficult. You might go wrong. Here, based on transaction wise, you go on writing journal entries. You can skip 3 4 working notes if you do journal. If you don't do journal, you would have to do 3 4 working notes, which is not usually your territory. It's very unique and new. Chances of missing some item is high. What's after this? That's it. Entire balance sheet done. Check the journal if there is something that you've not taken into consideration. First entry done, second done, third done, fourth done, five done, six done, seven, eight done, 9, 10, 11. This is the one we found as balancing figure. We ourselves found this. So everything's done in journal entries. Everything's tick in balance sheet. Close. Oh, capital reserve. Sorry. 110, 200. Shall I write it in reserves and surplus? Only reserve. 1,10,200. Capital 3,16,800. Capital reserve, but it's a reserves and surplus 1,10,200. Shall I write in balance sheet? Note number 1, share capital 3,16,800. Note number 2, reserves and surplus 1,10,200. Long term borrowings, there are two sets of debentures 7,86,000. Let me write 7,86,000. We need to write PPE, note number 4. PPE 7 lakh 9. Trade receivables note number 5, 431,500. 7 lakh 9 and trade receivables note number 5, 4,31,500. Everything's posted. All that I would have to do now is take the total. Take the total on the liability side, 8 lakh, 18 lakh 7,000. Take the total similarly on the asset side, Pakka. Very good. 18 lakh 7,000. By this, we complete the question on internal reconstruction. Ta-da!
Let's now solve question number 4 from our MTP2 or model test paper 2, May 2024 second series mock test paper. This question is on the topic of amalgamation. Let's start reading it. Following is the information of Anu Limited and Banu Limited as on 31st of March 2023 whereas under. Don't waste your time reading the balance sheet. Come to the end. Anu Limited and Banu Limited carry on business of similar nature and they agreed to amalgamate. So can I say both are transferors? Transferor is Anu and Banu. The new company, what is it that they created? A new company, Unbun Limited, was created. Unbun will become transferee. Anu and Banu will become transferors. What do they want us to do? Come to the end of the question. Compute the basis on which shares in Unbun will be shared between Anu and Banu. Total PC has to be divided between PC for Anu and PC for Banu. How do they share? They're asking us to compute. Maybe they've given us the information of PC. They want us to compute discharge of PC between two entities. And they also want us to do balance sheet. Balance sheet is easier here because Unbun is a new company created. If there was an existing company plus amalgamation accounts, whatever adjustments. Here, there is no existing company, new company created. Literally add Anu and Banu together and then call it Unbun. Isn't it? Let's proceed. See the adjustments. Assets and liabilities are taken at book value. Yes. Meaning what? Literally add. But there is exceptions. Following exceptions. Ooh. Number 1, goodwill is there. Anu 175, Banu 50. Plant and machinery is to be taken at 1,20,000. Plant and machinery of whom? Of Anu. Anu's plant and machinery value is changing. Plant and machinery of Anu. It's no. Sorry. That's changing. Okay. You have bright future. Huh? Debentures of Banu Limited are to be discharged by issue of 6% debentures at a premium of 5%. This is one more adjustment that's there. Here debentures of which company? Banu, Banu debentures. This has adjustment. Rest everything is same to same. Can we begin? We'll start with NATO come PC. If you take goodwill in the first set only, what you get is straight away PC. If you don't take goodwill, you get NATO, then you add goodwill, then you get PC. And in NATO PC, whatever assets are taken, same will be balance sheet asset. In PC, whatever shares you give, that will be share capital. And some liabilities will come in NATO. You write that in the format of Schedule 3, balance sheet Katham, 14 marks in pocket. I would write goodwill straight because I'm writing goodwill first. What will I get at the end? PC. If I want to find NATO, I will not write goodwill. I'll write every other asset, deduct every other liability. I'll get NATO, then I'll add goodwill. How much is goodwill in this case? 1,75,000 for Anu, 50,000 for Banu. Come to other assets. I'm going to take one asset at a time. Start from the assets, freehold property. How much? 375 and 3 lakh. Is there any change in the value? Take it as it is. Plant and machinery, 75 and 50, but there is adjustment. I should not take this at 75. They've told, take it at what price? This adjustment is done. This is also done now, 125. Will I take it at 75? I'll take it at 1,25,000. And Banu, 50. That's going to be 50. There's no change there. After that, motor vehicle. How much a motor vehicle? 37,525. 37,525. Then I have with me trade receivables. 2 lakh 50, 1 lakh. No change. 250, 1 lakh as it is. Then inventory 287,500, 225. No change. Write it as it is. 287,500 and 225. Then cash at bank 1 lakh and 50. Same to same. Cash 1 lakh and 50. 1 lakh 50. All the assets done. Now let's start deducting liabilities. To begin with, 5% debentures. 5% debentures and trade payables. 5% debentures. Anu is not there. For Banu, it is discharged at 5% premium. Hey, remember, this is not issue premium. They've told discharged at, there is no comma in between. So that is not issue premium. That is discharge premium 5%. What is the nominal value? 1 lakh 50. Agreed value 1 lakh 50 plus 5%. I would write it as minus, or I should write less and then underline. Anyways, it's fine. No? Trade payables 262,500, 162,500, 262,500, 162,500. There is change in the value of assets. Amalgamation is in the nature of purchase. Don't transfer reserves and surplus and share capital. That's it. All the assets and liabilities taken. Now, if you take, you will get net assets taken over, or in fact, PC only. 175 plus 375 plus 125 plus 37,500 plus 250 plus 287,500 plus 1 lakh minus 262,500. 10 lakh 87,500. 50 plus 3 lakh plus 50 plus 25 plus 1 lakh plus 2 lakh 25 plus 50 minus 162,500 minus 157,500. 480. That is the total extent to which they should give PC. PC should be that only. It includes goodwill. It includes, you can write this itself as PC if you want. Am I right? Have they told issue price of shares or anything? They've told shares are of 10 each. Nothing mentioned. Assume it to be issued at 10 only. Divide that 10 lakh 87,500 by 10. You will get 187, 1 lakh 8,750 shares to be issued to Anu and 48,000 shares to be issued to Ban. When I prepare balance sheet, intangible asset, freehold property, plant and machinery, motor vehicle, PPE, trade receivables, inventory, cash and cash equivalent, balance sheet side Damar, trade payables, long-term borrowing, and share capital, balance sheet tally, 14 marks. I'll prepare balance sheet. Help me to prepare it quick. Goodwill, 175 plus 50 together. 2,25,000 shall I write in intangible assets? Intangible assets. 225. If you want, you can prepare one notes to accounts. You can write it in notes to accounts. 225 goodwill. Am I right? Come back to this next item. What's the next item? Can I write freehold property, plant and machinery, motor vehicle? All the three items together as my PPE. Check that 375 plus 3 lakh, 675. 125 plus 50, 175. 37,500 plus 25. Let's write that in our property, plant and equipment note. Freehold property 375 plus 3 lakh. Plant and machinery 125 plus 50. Motor vehicle 37,500 plus 25. 9,12,500. Write it in balance sheet. Tangible asset 9,12,500. Note numbers we can write later. Anyways, I have prepared. I'll write it. What's after that? Trade receivables 250 plus 1 lakh 350. I would write it as trade receivables 350. Ta-da! I'm not preparing notes also for this. Then we have with us inventory, no adjustment. Write it as it is. 287,500 plus 225. 5 lakh. Let's write to 5 lakh 12,500. Then we have with us cash and cash equivalent. Add Madi. 1 lakh plus 50. 1 lakh 50. I would write cash and cash equivalent 1 lakh 50. I hope you guys got this. What do we have after this? Trade payables. Add them 262 500 plus 162 500. 4 lakh. I would write here trade payables 4 lakh 25,000. Got this? Come back. Debentures 157 500. 1 second. How did we settle them? We issued them 6% debentures. Right? 6% debentures 157 500. Don't rate as 5% debentures. Understood? Long term borrowing. I would write 6% debentures 157 500. And the same would come to our balance sheet. Long term borrowings 1,57,500. Okay. What do we have after this is done? NATO is done. PC. What did we give? Yeah, 1,08,750 shares of rupees 10 each plus 48,000 shares of rupees 10 each. Together 1,56,750 shares of rupees 10 each. 1,56,750 shares of rupees 10 each. 15,67,500. All the shares are issued for non-cash consideration. Don't forget to make the disclosure. I would write 15,67,500 in my share capital balance sheet. Now take the total 21 lakh liability side, asset side 21 lakh. Ta-da! Let's now solve question 5a from our topic of consolidation. This question is from model paper 2. And let's begin. It's not a full-fledged question where you need to prepare consolidated balance sheet in detail. Looks like a tiny question because there are two sub-questions in front. Let's see what is it that they want us to do. Calculate the amount of goodwill or capital reserve on acquisition of shares. So basically, you are supposed to compute goodwill or capital. That's it. Meaning you need to do that statement where you do cost of control, where book value of investment, nominal value of investment, compare them, and just pre-acquisition reserves, bonus issue, and all of that. Just that's it. There's nothing more than. I think there is some revaluation of assets also, creating revaluation reserve upward, downward, which will impact our resource. Let's begin the question from the top. Star Limited acquires 70% of the equity shares of Moon Limited. So Star Limited is the holding company. Moon Limited is a subsidiary company. Percentage of holding is 70. This will be crucial in dividing our share capital as well as in ascertaining the results. So results will be split between pre-post and then holding minority. There the ratio for splitting between holding minority is 70-30. They've given this piece of information. Take a note of this. Share capital of Moon Limited has to be split between holding and minority. I don't know how much is that of Star, how much is that of minority, but I would write Star Limited. Star Limited, the holding company, has how much percentage? 70%. Minority interest would hold how much percentage? 30. Do I know the share capital right now? I don't. And later, in cost of control computation, I would need reserves. Reserves have to be split between holding minority after we split it into pre and post. There again, the ratio is 70% and 30%. So the moment I pick the information that I need, I'll post it to the place where I need to write it. And only then I'll proceed to the next piece of information. Shall I get back to the question and read the next piece of information? What do we have after that? They acquired the shares for a cost of 140 lakhs. So 140 lakhs is the book value of investment. This is asset in the balance sheet of holding company. In the holding company's balance sheet, this is asset. Where would I write this 140 lakh? in my cost of control as an asset. Let me take you all to cost of control table. Here I would write book value of investment. How much is our book value of investments? 140 lakhs. This would remain in inner column. Why? We need to deduct our pre-acquisition reserves, pre-acquisition dividend from this. Only then that will go to outer column as asset. Then I'll compare it with nominal value of investment, which will be further adjusted for bonus issue if there is any. Then the difference, if the asset is more, it will be goodwill. If the liability is more, that will be capital reserve. What they've asked is just that. Everyone understood? Proceed. Yeah. What's after that? The following information is available from the balance sheet of. Have they given complete balance sheet? No. They've straight away started with assets side. You should have started with equity and liabilities. No. They've given PPE, investment, current assets, loans and advances. Till this 30, it is assets. This 180 and 100 is liabilities. A very important and crucial data in the balance sheet is missing. What is it? Share capital and reserves. We don't know. Do we need it? Yeah. Share capital has to be split between holding minority. Holding share of share capital should be written in cost of control as nominal value of investment. ಗೊತ್ತೇ ಇಲ್ಲ ನಮಗೆ. If we don't write this, how will we compare? If we can't compare, how will we find goodwill or capitalism? So there's a missing piece in the balance sheet. What should we do? We should draft the balance sheet newly. To draft the balance sheet, you. So we have assets and liabilities. Write these assets and liabilities. Balancing figure will become capital if they don't give information to us. Let's just see if there is any other information. Do we have any other information about balance sheet? They told following revaluations have been agreed upon, not included in the above figures. So above figures are there, no? That is from standalone balance sheet. After we take that data, then we've done this revaluation. What revaluation have we done? PPE has been up by 20%. We need to increase the value of PPE by 20%. Come to PPE, PPE, PPE. Here, 240 is there. We should increase it by 20%. So 240 is not the value. We should do upward revaluation by 20%. How much upward revaluation by? Do 240 lakhs into 20%, 48 lakhs. You agree with me? So here in my reserve analysis, I'll write one revaluation. PPE, I'm going to do upward revaluation by 48 lakhs. You agree with me? Then they've given another piece of information which talks about investments. Investments have to be downward revalued by 10%. Investments is not the investments which is here, not this 140 lakhs. They've given some other investments here, 110 lakhs. Do you agree with me? This investments of 110 is now revalued down up, down by 10%. Sir, is this investment included in this? This is investment asset in the books of holding company. This balance sheet is balance sheet of subsidiary company. You got it? So this 110 down by 10%. How much is 110 into 10%? 11 minus alva. Yeah. So I would write investments minus 11. PPE plus 48. Net will be 48 minus 11, 37 drop. So when we revalue the PPE upwards by 48, revaluation reserve credit is created by 48. When we reduce investment by 11, revaluation reserve should be debited by 11. Credit 48, debit 11. That's nothing but credit 37. Can I say there is revaluation reserve created to the extent of 37? This reserve has to be analyzed into pre and post. Am I right? Yes. You tell me, pre post, or what is the basis of bifurcation? We know it for sure that revaluation reserve is always pre. Revaluation reserve is always pre. On this revaluation reserve, if we do any depreciation after revaluation, if we do any depreciation, that will be always post. Everyone's clear with this? So with regard to revaluation reserve, no confusion. It's always completely pre-acquisition reserve only. Got it? What do we have after this revaluation reserve adjustment? Then Moon Limited declared and paid dividend at 20%. Moon is subsidiary. Subsidiary has paid dividend of how much? 20% on its equity shares. So this is paid for the year ended 31st of March 2024. When did we acquire their shares? We acquired their shares on 31st of March. So are we holding the shares previous year? No. This dividend, what will be received? It is received during the period which we were not the shareholders. Yeah. Can I call this pre-acquisition dividends? Yes, yeah, pre-acquisition. We are receiving dividend for previous year. We bought the shares at the end of previous year. We were not holding the shares throughout the year, no? When the profit was earned in the previous year, were we shareholders? When the profit was earned in the previous year, were we shareholders? No. Using that previous year's profit, when they give dividend in the current year I received dividend because I have bought the shares. I bought it in the last day after everything is over. I bought. So when I receive dividend, that dividend is given out of the previous year profit, during which I was not a shareholder. So the profits were earned before I became a shareholder. It is pre-acquisition profits. Such pre-acquisition profits, which is belonging to holding company, should not be treated like revenue reserve. It should be treated like capital reserve. Basically, meaning it should be deducted from the cost of my investment. Yes, 13 also will do the same thing. You remember, pre-acquisition dividend will be written in the credit side of amount column. Post-acquisition dividend will be written in the credit side in dividend column. It will eventually go to P&L. So 20%. 20% is not of profit. 20% is of capital. But I don't know capital. Do you know capital right now? Don't proceed. On its equity shares as on 31st of March 2024, face value 10 per share. But how many shares? We don't know. Star Limited purchased shares of Moon Limited at 20 rupees per share. This 140 is there, no? These many shares, these 140 lakhs, this purchase of shares at what rate? 20. So I know 140 lakhs is the total amount. I know per share it is 20. Can I find number of shares? Very easy. 140 lakhs divided by 20. What do you get? Can I say I was holding 7 lakh shares? That is 140 divided by 7 lakh shares. Nominal value per share is 10. So can I say my nominal value of capital in the subsidiary, what I have, is 70 lakh rupees. Do you agree with me? So the nominal value of investment is 70 lakh. Nominal value of investment is everyone. 70% is 70 lakh. So minority 30% will be 3 lakh and 30 lakh. 3 lakh shares and 30 lakh rupees. Can I say total capital will be 100 lakh? You agree with me? Now you will say, sir, then all good. Then we don't have to prepare balance sheet. Why? I told you the balance sheet only one item missing is capital. Now that capital is found. There is one more item missing in that balance sheet. Reserves. So now we know capital also. So we'll write all assets, all those two liabilities, and we'll write capital to find reserves as balancing period. That reserves is the reserves on the date of acquisition. That will be pre. After that, whatever is earned will be post. Everyone understood? Okay? No doubts? Let's proceed. What is the next piece of information available? Then we've been told that's it. Calculate amount of goodwill or capital. Yeah. Now help me with the preparation of a dummy balance sheet. So shareholders funds. Do you know how much is their shareholders fund? Do we know? We don't. We know, right? We know. 7 lakh is the number of shares that we hold for 70%. So minority will have 3 lakh shares for 30%. Putting it together, it is 10 lakh shares, 100 lakhs. 10 lakh shares of rupees 10 each. Can I say the share capital is 100? Reserve or surplus? We don't. This is the balancing figure that we're trying to find. This is the balancing figure that we're trying to find. What about their long-term borrowings? What is the other items that they have? Liabilities is 15% debentures and current liabilities. 15% debentures 180, current liabilities 100. I'll write 15% debentures 180, current liabilities 100. This is liability side. Done. Come to asset side. Asset side, I have property, plant and equipment 240. Should I take the fourth revalued figure? No, no, no. Take 240 only. If you take 240 plus 48, revaluation reserve in this only you will get it. But we have taken revaluation reserve already, no? We're trying to prepare the balance sheet on the date in which we acquired the shares of the company, not the balance sheet after revaluation. Further, yeah, revaluation is done for the purpose of assets to be shown in consolidated balance sheet only. We are not doing revaluation in standalone. Are we doing revaluation for standalone financial statements? No. Revaluation is done only in consolidated financial statements. Do you all agree with me? Very nice. So 240 property, plant and equipment. What other assets are there? They have investments of 110. Don't take that minus 10% value. Take 110. And current assets 140. Loans and advances 30. Shall I get all three once for all? 110 investment, loans and advances 30, current assets 140. Now the balance sheet has to tally that of subsidiary. We have assets and outside liabilities given in the question. Indirectly, they've told how much is share capital. That is how much holding company holds, they've told. Using this, we form this. Take the total on the asset side. 240 plus 110. 350. 350 plus 140. 390, 490. 490 plus 30, 520. 520 minus 280, 380. 520 minus 380. 140 is the reserves as on the date of acquisition. This balance sheet is prepared as on the date of acquisition. On that date, how much was reserves and surplus? 140. So when I do my reserves analysis here, we did revaluation reserve. Now I do general reserve. How much was general reserve? 140. And this entire 140 is pre-acquisition. So how about post? Have they told that there is any profits earned after the acquisition? Have they told? No. So you know what we are doing actually? We acquired shares on 31st of March. We're doing consolidation on 31st of March only. Alle lottery, alle 31st of March, we bought the shares. 31st of March, same year, we're doing consolidation. So there is nothing post. Everything is pre. Everything is just purchased and consolidation. Up to now you bought and you're immediately doing consolidation. You understand? Quite unique, no? Simple, not many complications. Yeah, but slightly unique from the earlier codes. Post acquisition will be zero. Now we know 140 pre acquisition because of general reserve, 37 pre acquisition because of revaluation reserve. So can I say total pre acquisition reserves is 177? I will take 177 as pre acquisition. Post, post is zero, post is zero. I'll write post as zero. I agree that the way we are solving consolidation question is very different from how the answer will be usually presented in ICA study module, suggested answer, or any author material. But we have our own flavor of doing this chapter. And in our way, this is quite nice and soothing. For those who are watching this for the first time, you might find it very different. It is different, not complicated. In case you do the entire AQs that we do from the beginning and then come till here, you'll understand how beautiful is the flow of this topic. Yeah. Just have to be patient enough to go back and then visit those questions that we. Yeah. Now let's split this 177 between holding and minority in the ratio 70/30. Do 70% of 177. Very nice. 124. And 30% of 177. Anyways, post acquisition is zero. Pre acquisition reserves of 124 will be taken to very good. No, not balance sheet. It will be deducted from our book value of investments in cost of capital. We forgot to do one thing. We have not deducted pre-acquisition dividend. ಮಾಡಬೇಕಿತ್ತು ಆವಾಗಲೇ ಮರ್ತೋಗಿದ್ವಿ. Shall I do that also? Before that, I'll write this minority share of 53 in minority here, 53. And minority share in capital is 30 lakhs. Alright. Is there any revenue reserve? No revenue reserve. Nothing will be posted to balance sheet. Then what was the rate of dividend what they gave you? 20%. 20% of capital. What is the nominal value of the capital that we hold in the subsidiary? 70. In 70, identify 20% of 70. 14. I will deduct 14 as pre-acquisition dividend from the cost of. Everyone understood 14? He'll read 70 into how much percentage? 20%. 14. Done. How much is this 140 minus 14 minus 124? This I'll just give you another piece of information here. Yeah, 2. So 70 is nominal value, book value is 2. Which is more? Liability is more by 68. 68 will become goodwill is negative. Or if you want, you can write capital. They've actually asked in the question how much is goodwill. Correct? Really, friends. Goodwill or capital. So, okay. Goodwill is minus 68. Capital reserve is 68. That's it. This is what they've asked in the question. 7 marks? Yes. Yeah, very soothing, simple. First, I did share capital analysis, then I did reserve analysis, and then apportion the reserve between holding and minority in the ratio. Minority interest is not asked, but I still computed minority interest to be 83, and then I eventually arrive at my cost of control computation, in which I computed my goodwill or capital. Understood? Let's now start question 5B from our model paper number 2. This question is on the topic of accounting standard 21 consolidation again. Rather than asking one 14 marks question, no, in model paper 2, they've asked two 7 markers. First one is about computation of goodwill or capital reserve. Let's see what is it that they're asking us to do in the second one. Gamma Limited, or you can say Gamma Limited, acquired 24,000 equity shares of rupees in Pita Limited. So Gamma becomes the holding company, Pita becomes the subsidiary company. And this is happening on 1st of October 2023 for a price of rupees 4,60,200. P&L account balance account, okay, leave all that. Come to the end of the question. What do they want? You are required to compute impact of revaluation of plant and machinery. So there is some revaluation of plant and machinery. They're asking you what is the impact because of this revaluation. Remember, this revaluation will have no impact on standalone financial statements of subsidiary. This revaluation is happening for the assets and liabilities or for the assets of subsidiary company exclusively in the process of consolidation and not reflecting in standalone financial statements. Shall we proceed? Okay, how much percentage of the shares do we have? We don't know that. We have 24,000 shares. And look at Beta Limited's balance sheet. They have 3 lakh rupees worth of share capital, which includes shares of rupees 10 each. Do 2 lakh 40 by 3 lakh or 3 lakh by 10 will give us 30,000 shares. We hold 24,000 out of 30,000 shares. How much percentage of the capital do we hold? So can I say it is my 80% subsidiary? Observe, share capital of beta is 30,000 shares over rupees 10 each, which comes to 3 lakh. In this alpha, correct? No, gamma. So how much does gamma hold? 24,000 shares, which is 2 lakh 40,000, which is 80%. I hope everyone understood clear. And minority will have that remaining 20%, which is 60,000. And in our cost of control, I would write nominal value of investment to be how much? 2 lakh 40. This should be adjusted for bonus issue if there is any, but there is nothing of that type in this question. Let's proceed here. And if you want, I can write minority interest also, which is not been asked. But if you are preparing minority interest, you can write that amount in minority interest. See, then they told on 1st of October 2023, that is the date on which I got. For with 460-200. What is 460-200? Conflict investments. Book value. So this book value will appear in my cost of control separately as an asset. This will be compared with my liability amount to find goodwill or capital reserve. We are not done yet. This has to be adjusted for pre-acquisition dividend and pre-acquisition reserves. And that revaluation reserve, whatever happens because of change in the value of assets, will be pre-acquisition reserves only. Got it? But after the revaluation of the asset, further we do depreciation, no? Such depreciation we do will be post acquisition. That has to be adjusted with our revenue reserves, which will straight away go to balance sheet. Clear? Let's proceed. Read what's happened. The profit and loss account of Beta Limited showed a balance of 15,000 on 1st of April 2023. 1st of April is beginning of the year, that is before we acquired. But how much was it showing? 15,000. Then the plant and machinery, maybe let's assume that 15,000 was there till 1st of October also. It was same till 1st of October also. So can I assume in that pre-acquisition part, I would write it to be 15,000? However, let's see whatever is given later. I think there is P&L account balance given here also. No? We'll take this 123 and 150. 150 is general reserve. 150 is general reserve, and 150 is their general reserve. And we also have one more thing. 123 is their P&L. Let's see the other adjustments and then write them once more. The plant and machinery of Beta, which stood in the books at 2,25,000 on 1st of April 2023. When did we acquire the shares of the company? 1st of October. On what dates value have they given? 1st of April. Will I revalue 2,25,000? No. 2,25,000 will be depreciated till 1st of October. You got what I'm trying to tell? And then I'll do revaluation. I will not do revaluation on the beginning of the year. Revaluation will happen on the date of acquisition. You guys understood this? So from 1st of April till 1st of October, how many months? 6 months. April, May, June, July, August, September. 6 months we need to depreciate the 2,25,000 at whatever rate they say. After that, we will do the revaluation. Is that okay? We have told further that it was considered worth 2,70,000 on the date of acquisition. So there is revaluation. Do you consider 225 to be revalued to 270? No. 225 is not April first. Depreciation till whatever value you get, that will be revalued to 270. And on the 270, what depreciation you charge will be post acquisition. And 225, what depreciation you charge to make it till 1st of October is free only. After that, you arrive at some value that will be changed to 270. That revaluation reserve is again free. I'll write it with the dates. Remember, 1st of April, 2,25,000. Depreciate for 6 months. Rate we don't know. So that whatever value comes, that will be revalued to 270. Then depreciate for remaining 6 months. That is the consolidation. Everyone understood? Okay, then do we have depreciation information anywhere? No. But 2,02,500 is the value of the plant and machinery. That is after full year depreciation. That is after providing depreciation for full year, 2,25,000 became 2,02,500. See, this is 1st of April 23. This is 31st of March 24. How much is the difference? 2 lakh 25,000 minus 2 lakh 2,500. 22,500. Divide 22,500 by 2 lakh 25,000. 10% is the rate of depreciation. In standalone, they will take 2 lakh 25,000. They depreciate it by 10%. 2 lakh 2,500 only will be considered. That is correct. For what? For standalone financial statements. For consolidated financial statements, I need to revalue it to 2 lakh 70 on 1st of October. That is after 6 months from the beginning of the year. So what is it that I would do? See, they have told the asset is of value. How much? 2 lakh 25,000 at the beginning of the year. They have depreciated it. I don't know by how much. The closing value on 31st of March 2024 has become 2 lakh 2,000. We identified that depreciation is 22 point. You agree with me? Now, at the beginning of the year, if it is 2 lakh 25,000, for standalone, they've done full year depreciation. For consolidation, I have to do half year depreciation, revaluation, and then half year depreciation. So, in order to do revaluation as on 1st of October, I need to identify depreciation till 1st of, which is 6 months. Here it is 12 months. If you divide now, you will get, see, if this is considered to be 100, right? Then this would be 10, no? Whereas this is a 9. Now, here if this is considered to be 100, here depreciation will be 10%, but into 6%. Very good. You get this depreciation at 10%. Have they mentioned 10%? No, right? We only found it. We found it. So instead of writing 100, 10, and 90, what I would do is I would do 22,500 divided by 2 lakh 25,000. You understood this? Better off writing here, no? Than here. So, which is very good. 10% is the rate of depreciation. That is the reason I'm going to depreciate here at 10%. So 10% depreciation, 2 lakh 25,000 into 10% into 6 by 12. Yeah. How much? 11,250. Everyone understood 11,250? Depreciated by 11,250. What do we get as the book value on the date of acquisition? 2 lakh 13,000. See this. Before revaluation, it was 2 lakh 13,750. Am I right? After revaluation, it has to become 2 lakh 70. They've told us the value to be 2 lakh 70. Am I right? Am I right? Okay. Trying to make it without that rupee symbol. Better now. 2 lakh 13,750 is the value on the date of acquisition before revaluation. They're telling once you revalue, it will become 2 lakh 70. Will 2 lakh 13,750 become 2 lakh 70? We did revaluation upward. How much revaluation upward? 50, 56,050. Sir, how do you get that? Simple, yeah. I did 2 lakh 70 minus 2 lakh 13,750. Upward revaluation, downward revaluation. Upward revaluation. I'll write in revaluation result 56 to 50. Port. Port is 0. Everyone got this? Now, on this 2 lakh 13,750, they've already charged the depreciation. How much depreciation have they already charged? 11,250 for first 6 months, 11,250 for next 6 months, bringing the value to 2 lakh 2,500. Now, please don't do 213,750 into 10% into 6 by 12. You will get wrong. Don't do 213,750 into 10% into 6 by 12. Why? Annually ಮಾಡಬೇಕಲ್ವಾ ನೀವು 6 months ಗೆ ಒಂದ್ಸತಿ WDV ಮಾಡಿದ್ರೆ ಡೆಪ್ರಿಸಿಯೇಷನ್ ಚೇಂಜ್ ಆಗ್ಬಿಡುತ್ತೆ. So don't do that. Full year depreciation was how much? Yeah, 22,500. First 6 months, 11,250. Second 6 months, also 11,050. This is already what is done. Is already what is, but this depreciation is wrong. Why? In the standalone PL, they have done depreciation of 10% for the entire year on 2 lakh 25. But for consolidation purpose, on the date of acquisition, the value changed. So for the second 6 months, from 1st of October to 31st March, depreciation is not 2 lakh 25 to 10% to 6 by 12. Revaluation to 2 lakh 70, you should charge depreciation at 10% on 2 lakh 70 for the second 6 months. When did you revalue the asset? 1st October. When is year end? 31st March. October to March, depreciation has to be computed. No. If you have 2 lakh 70, total revaluation figure. Now do 2 lakh 70,000 into 10% into 6 by 12. 13,500. In consolidation, the value of plant and machinery that is supposed to be considered is 2 lakh 56,500. 2 lakh 25,000 minus 11,000 will be depreciation for first 6 months, then plus 56,250 revaluation upward, then 13,500 depreciation, then 2 lakh 56,500 will go to consolidated balance sheet. I repeat, plant and machinery of the subsidiary Gamma Theta was how much? 2 lakh 25. That is at the beginning of the year. When did we acquire? 1st of October. Depreciated 1st of October. How much? 11,250. When you depreciate till 1st of October 11,250, what do we get? 2,13,750. Then we do upward revaluation. Pay how much? 56,250. Upward revaluation when you do 56,250, it will end up becoming 2 lakhs 70. After it becomes 2 lakhs 70. Further, you should charge depreciation for the remaining 6 months. For the remaining 6 months, which is 13,500. If you charge that, you will get 2,56,500. They have not asked you to do consolidated balance sheet, but if you do consolidated balance sheet, 2,56,500 is the value of plant and machinery of subsidiary, which will be taken to holdings consolidated balance sheet. We have done AQ on this. Yeah, asset revaluation, upward with depreciation, downward with depreciation, middle of the year with depreciation. We have done that. Please go back home and then revise this once. You'll be able to connect it. Okay, cool. Now, how much is the depreciation already charged? 11,000. Am I right? In standalone. How much is the depreciation that should have been charged? 13,500. So we need to charge extra depreciation now. How much extra depreciation? 2,000. Or in other words, we did 56,250 upward revaluation. No, new value of asset which was not there till now. Correct or not? When did we do this revaluation? On 1st of October. On that upward revaluation, we should charge depreciation no for 6 months. Do 56,250 into 10% into 6 by 12, you will still get the same number. You will still get the same number. 2,250 only you will get. Bargelva. 56,250 into 2,000. Okay, fine. Let's forget that. Somewhere something is missing. But basically, depreciation already charged is how much? Very good. Depreciation that should have been charged is how much? So the difference is how much depreciation that should be charged now? 2,250. Everyone got 2,250. This depreciation will be post acquisition part. You agree with me? It should be written in P&L. It should be written in P&L. But do we have any such item? No, only one item. I wrote 2,250 minus decrease in profit in post acquisition reserve. Pre acquisition reserve is 56,250. Why? There is general reserve, there is P&L. I've decided not to consider this because they're asking only impact of revaluation. Are they asking full-fledged consolidation? No, only impact of. So 56,250 pre-acquisition reserve arising because of revaluation. 2,250 minus is post-acquisition reserve negative arising because of revaluation. Share it between holding and minority. What is the ratio? 80 and 20. Okay, 80, 20. 80% of 56,250. 45,000. Where would you write 45,000? Book value only minus margin. Come to cost of control. In book value of investment, I will deduct 45,000. What do we get? 460,200 minus 45. 4 lakh 15, no, 14,800. 15,200. Sorry. And what do we do with this minority share? It will go to minority interest, which you are not preparing in your not asked. Post acquisition part will go to revenue reserve in balance sheet. Yeah, minus. Don't care. Do we care about this? No. And that's it. We are done. So this will be 2 lakh 40, 4 lakh 15,200. Asset is 450 to 40. Liability is 450,200. What do we get? Sorry, asset is 450,200. Asset is 240. Goodwill of how much? 175. We have not given impact of P&L, general reserve, and everything. You understood? Because they have not told how much of it was it on the date of acquisition, how much pre, how much post. We don't have that bifurcation. And that's it. You stop your answer here. Here, this depreciation, I know minus 2,250. Pre acquisition, I have no clue. Yeah. I don't know the split. Do I know it? I don't. This is the cute answer. looks incomplete. No, we were usually used to do the big problem with lot of other adjustments. This is like adi adi, like khatam. Shareholding, cost of control, P&L, plant and machinery acquisition data, followed by our asset revaluation. And that's it, friends. We are done with this question with analysis of results. Question 6A from our model test paper number 2. In this question, there is the internal choice. And both the questions, which is given as choice, is from framework for preparation of financial statements, which is chapter 2 from our syllabus. Very small chapter. In the class also, we hardly took 1 day to finish. But weightage wise, no, for the time that we put good weightage here. This is one chapter. What if it comes in the exam, you should not skip. There is this accounting equation based question, financial statements when there is no going concern question, and there is that capital maintenance, stock units and everything. So don't skip. Please do this topic. Let's see. Before we do this practical one based on accounting equation, let's do this theory question. What does it say? One of the characteristics of financial statements is neutrality. Do you agree with the statement? One of the characteristics is neutrality, right? But the characteristic states that financial statements are not neutral. They are not neutral. Financial statements are biased. Meaning what? They vary based on the accounting policies we pick. If you pick a certain set of accounting policies, financial statements will give a kind of picture which is inducing you to take decision making in a specific way. But if you change the accounting policies that you follow, then the way the financial statements look will change. And based on that, the new decision that you take will be completely different. So, financial statements are not neutral. Financial statements are actually biased, meaning it's different based on the accounting policies we follow. And it will impact the decision making in this process. That's the answer for this 6A. Please do read it from our chart. It's there in the revision video also. Okay, let's get back to 6A, second option. Opening balance sheet of Mr. Amit is showing the aggregate value of assets, liabilities, and equity to be 16 lakh, 6 lakh, and 10 lakh. We know no assets minus liabilities is equal to capital. So asset is 16, liabilities is 6. Capital will be 16 minus 6. That's matching. They've given list of transactions 1, 2, 3, 4. They wanted to show the impact of the sales on the balance sheet. Let's write it here. What I would do is I've written all the adjustments here 1, 2, 3, 4 adjustments, whatever they've given. Opening data is like this. Asset is 16 lakh. Liabilities is 6 lakh. So 16 minus 6 if I do, I'll get my equity as 10 lakh. Did everyone get this? Fine. Let's quickly start solving one adjustment at a time. First one. We earned 10% dividend on 4,000 equity shares of rupees 100 each. When we earn 10% dividend on the investment that we have, investment is of 4,000 equity shares. Each share is 100 nominal value. Take your calculator and type 4,000 into 100 each. You get 4 lakh rupees as investment at nominal value. On this investment, you receive 10% dividend. So 4 lakh into 10%. 40,000 rupees is dividend received. Dividend received is income and it will increase my asset, that is cash. If you received it, it will increase cash. Cash is included in asset. Asset was 16 lakh. Now when I receive 40,000 dividend, can I say my assets will become 16 lakh 40? Why? Cash increased by 40,000. Liabilities will not change. It will remain the same. And this 40,000, whatever is received as dividend, is income. Income will become profit. Profit will increase equity or capital. So 10 lakh worth of capital will become 10 lakh. Now check in your calculator 1640 minus 6 lakh. Do you get 10 lakh 40? Accounting equation is balanced at the end of first transaction. One transaction, one mark. Shall we go to second transaction? What's happening in the second transaction? Paid rupees 1 lakh to credit us for settlement of 1 lakh. How much is our liability? 1 lakh 40. How much did we pay? So my cash, which is there in the assets, will reduce by 1 lakh. So 1640 will become 1 lakh less, becoming 15. And liability will decrease to the extent of not 1 lakh. 1 lakh 40,000 worth of liability will decrease. Liability is 6 lakh. You deduct 1 lakh 40. 4 lakh 60. You understood? Now, how much was I supposed to pay? 1 lakh. How much did I pay? 40,000 discount. Discount will become income. Income will become profit. Profit will increase capital. To 10 lakh 40, you add 40. Now check if the mathematical equation is correct. Do 15 lakh 40 minus 4 lakh 60. What do you get? 10 lakh? Everybody? Fantastic. Can we go to the next item? What do we have after that? Rent of premises is outstanding at 20. We have taken premises on rent. We've incurred expenditure of 20,000. But have we paid? We have not paid. If we had paid, my assets would have increased. Because I have not paid, my assets will remain same 15 lakh. You get this? Outstanding rent will appear, which is a liability, because of which my 4 lakh 60 liability will increase by 20, becoming 4 lakh 80. And rent is an expense. Expense will reduce profit or create loss, which will reduce capital. Capital was 10 lakh 80, deduct 20, it will become 10 lakh 60. Check the equation 1540 minus 4 lakh 80. Do you get 10 lakh 60? Very nice. Can we see the next item? What do we have next? Mr. A withdrew 18,000 rupees for his personal use. How much money did he withdraw? 18,000 rupees. When he withdrew 18,000 rupees, he withdrew it in the form of cash. Cash is there in assets. Assets 15 lakh 40 will reduce by 18, making it 15 lakh 20. This will have no impact on my liabilities, but this 18,000 money withdrawn is drawings, and this drawings will reduce our capital. 10 lakh 60 minus 18, 11 lakh 22. Did you all understand that my assets will reduce by 18,000 and my capital will reduce by 18,000? Correct? Fantastic. This is the answer for question 6A. Let's now solve question 6B from our model test paper number 2. This question is on internal reconstruction, a very small, sweet 4 marker question which has 2 accounting entries that's been asked. This is happening in the books of C Limited. They have authorized capital of 5 lakh, which we don't care, which is divided into shares of rupees 100 each. Out of this, how many shares are issued? Relevant piece of information. As of now, the share capital of the company constitutes of 4,000 equity shares of rupees 100 each, which constitutes to 4 lakh. And in June 2022, company decided to convert issued shares into stock. So share capital will decrease. Debit share capital. Equity share stock will get created. Credit equity stock. By how much? 4,000 shares into 100. How much will pay? 4. So in the month of June, in the year 2022, debit equity share capital comprising of shares of 100 each. How many shares? 4,000 shares into rupees 100 per share, which comes to 4 lakh rupees. This is now converted into equity stock. What value? 4 lakh. This narration would be conversion of equity share capital into stock. Then what's happening? But in June 2023, exactly 1 year from now, company reconverted. Company told ಮತ್ತೆ convert ಮಾಡೋಣ. Yeah. What? Stock into shares. But this time shares are not of rupees 100, but it is of rupees 10. Anyways, the amount will be same in the total. I would write the entry equity stock account debit. Stock does not have any fraction or any denomination. This will be 4 lakh rupees. This is happening in 2023 June. Credit will be equity share capital. Divide the same 4 lakh by 10 rupees. You will get 40,000 shares. So it is going to be not 4,000 shares of 100. It is going to be 40,000 shares of rupees 10 each, becoming 4 lakh again. And this is what they was past accounting entries. And show how the share capital will appear in notes to accounts as on 31st of December 2022 and 31st of December 2023. Observe the balance sheet extract. Initially, before 2022, in 2021, equity share capital was 4,000 shares of rupees 100 each, 4 lakh. When you convert 4,000 shares of rupees 100 each to equity stock, it becomes 4 lakh. In the note stock box, you will show this equity stock 4 lakh. In 2023, you convert that equity stock to shares of rupees 10. When you prepare balance sheets, notes to accounts on 31st of December 2023, it would look like this 40,000 shares of rupees 10 each, which comes to 4 lakh rupees. Got it? Fantastic. Let's now solve question 6C from our model test paper 2. And this question is from the topic of branch accounting. What have they asked us to do? Alpha of Chennai has a branch at Mumbai. Very nice. To which goods are sent at 20% above cost. So let's say the cost is 100. Load is 20. Invoice price will become 120. So 100 rupees worth of goods are sent by the head office to branch at 120 rupees. Cost 100. load 20, invoice price 120. And what is it that they want us to prepare? Branch makes both cash and credit sales. Okay. Branch expenses are partly made by head office, partly by branch. Okay. Expenses incurred by the branch every month is sent to head office. This is a dependent branch. Further details are available. What do they want us to do? You are required to prepare branch stock and branch data. You tell me. Branch stock account, stock opening, goods sent to branch, and say and closing balance should be written at cost price or invoice price. Invoice price. Load on this has to be removed by preparation of a separate account called branch stock adjustment account. Have they asked us to open branch stock adjustment? No. They've asked two ledgers. One branch stock, two branch returns. Usually for this kind of question, we used to open stock data system only, branch stock ledger, branch data ledger, branch expense ledger, branch stock adjustment ledger, branch expense ledger, branch asset, branch PL. Ultimately in PL we used to find the profit. You remember? They've not asked much. They've asked only one to branch stock, the branch data. Let's do that. Keep the format of branch stock and branch data ready and then start reading the question. One complete page branch stock, one complete page branch data. So remember, both are assets. Debit increase, credit decrease. Debit inflow, credit outflow. To begin with, we have been provided with information of cost of goods sent to branch at cost. We need it at invoice price. 2 lakh is the cost. What is invoice price? Plus 20%. 2 lakh plus 20? So in my branch stock account, I would write two goods sent to branch. How much is that? 2 lakh plus 20%. ಎಷ್ಟಾಯ್ತು? 2 lakh one. On this 2 lakh 40, which is there actually at invoice price, that 20%, which is 40,000, has to be removed as load. Where in branch stock adjustment account, I would have to write on credit side. But I am not preparing that. Why? They are giving us only 6 marks. If I would have given 14 marks, I would have written that. Everyone understood? Come on, yeah. What's after this? Then we have goods received by branch. Goods have been received by branch till 31st of March, sorry, 31st of December 2023 at invoice price is 220. If they send 2 lakh, how will we receive 2 lakh 20? This 220 is at invoice price. 2 lakh is at cost. So the invoice price of goods sent is 2 lakh 40. We received only 2 lakh 20. Remaining 20,000 is still on the way. So when we write here closing inventory, balance carried down, I would write two variants. One, stock at branch. Second one, CETA, stock in transit. Stock in transit is 240 minus 220, 20,000. We've done the exact same problem with same numbers in the class. I remember the numbers 240, 220. You can check once after the class is today. But did you understand this 20? Make some noise. What do we have after that? Credit sales for the year at invoice price. Cash sales for the year at invoice price. Credit sales, cash sales. Both the sales will reduce my inventory. This is like my trading account, stock account. I'll write on the credit side. For credit sales, I'll write by branch debtors. For cash sales, I'll write by branch cash. Branch will collect the cash and then send it back to head office later. You agree with me? If you had opened branch cash, I would have written debit side two balance brought on. I would have written this also. Credit side, I would have transferred the cash back to head office. How much is debtors? I'm going to say credit sales 165, 150 lakh. They've asked us to prepare branch debtors account also. In branch stock, I've written by branch debtors. In branch debtors, I will write two branch stock. I don't know opening balance of debtors. I will write it later. Then I'll write branch stock credit sales 1,65,000. Easy. What is after this? Cash remitted to head office. This will be of no impact in our stock and debtors. I told you I'll open branch cash, debit side opening balance, and then cash collected from debtors, cash sales money collected, credit side cash remitted to head office, and then closing balance. If there is expense paid, we'll write that also. We used to do questions with so many ledgers, but this question is sweet. That line of information is irrelevant. Expense paid by head office. It will be entered in head office cash account credit side and in your branch expense account debit side. Entry was branch expense account debit to head office cash. But we are not preparing branch expense ledger. Why? They have given us only 6 marks. Itne marks के लिए इतना it's मिलेगा. You give us 14, I will do branch expense and branch cash. Are they giving 14? They're like, no, I can give you only 6. You're like, okay, then I'll give you only debtors and cash. Sorry, debtors and cash debit. Then expense paid is also done, not relevant. Then we have bad debts written off. How much bad debts written off? 750. This will reduce our debtors. In my debtors account, I'll write on credit side by bad debts, which will be posted to branch PL. This will be posted to branch PL. Branch PL debit side again, I should write this branch bad debts. 750 done. Next, we have closing balance and opening balance given. Stock. They have given cost 25. Do I need it at cost? No, I need it at invoice price. Cost is 25,000. Invoice price is 20% more. Do 25,000 plus 20%. In my branch stock account, I would write debit side to balance brought down 25 plus 20%, 30,000. This is opening stock 25,000 plus 20%. Or I'll eliminate that word opening stock. But it is out. Nice. Everyone understood this? And 25,000 is the cost, 20% load, it became 30. 5,000 rupees, which is load, should be written in stock reserve account. When say in branch adjustment only, I can write credit side, stock reserve. Or open separate branch stock reserve, there you write credit side, that will again be close by writing to branch adjustment. From branch adjustment, difference will be posted to branch PL. You recall some parts. There are two detailed revision videos on branch accounting, part 1, part 2. Please do revise it if you think you have forgotten what we are discussing right now. What do we have next? Then closing balance 28. As it is, you write in branch stock, credit side. How much? Stock at branch 28,000. It is already at invoice price. So you don't identify cost. We are not preparing branch stock reserve ledger. If you are preparing on the debit side, I will have a new load on this 28,000. How much is load? Yes, 28,000 into what? 20 by 120, because 28,000 is including load. Cost 100, load 20, invoice price 120. So from 28,000, if you have to arrive at load, should do 28,000 into 20 by 120. Not asked in this question, but I'm just still giving you a knowledge about the SIP. Got it? Then they've given debtors. How much is debtors opening balance? 32,750 opening, 26,000 closing. Debtors opening balance 32,750 opening. I would write here closing 26,000. Is there something missing in debtors? Yeah. What? Cash collected. Why? 32,750 is what I have to receive from my debtors. I've given them 1,65,000 rupees worth of goods. So they should give me 1,97,250. No, they gave 750. They should still give me 1,97,000. How is it 26? There's a missing figure there. Some amount of cash is collected from them. You got it? Then that's it. No other piece of information in the question. That cash opening and closing would have come in my cash account if they had asked me to prepare. They have not asked, I won't prepare. In the regular class, though they asked 2 ledgers, we ended up doing 4, 5 ledgers. But in the exam, unfortunately, of late, branch accounts weightage has been 6 marks. I'm not telling you it will be asked for only 6. But I'm not telling you it will be asked for 6. Big chapter, but of late, in the last 4 attempts, if you observe, it's been asked only for 6 marks in each exam. Got it? Then let's write this ledger closing. Branch stock ledger closing will be like GP. It will be like GP, but not exactly GP, because it is difference between invoice price and sale price. Identify the balancing figure here: 165, 59, 28, and 20. Together it comes to 272. 272 minus 270. 2000 branch adjustment account. This will go from here to branch adjustment. In branch adjustment, that stock reserve, load on purchase, load on goods into branch, everything will be removed. From there, it will go to branch PL. Understood? Then come to branch debtors. I'll take the total here 197,750 and deduct 26,750. Balancing figure is cash collected from my debtors, which comes to be 1,71,000 rupees. Got it?